Equities trying to bounce here. 3 weeks of losses on the S&P 500. Longest weekly losing streak of the year so far. Futures up by 0.5% on the S&P. The intraday low of the year on a 2-year yield coinciding with a closing high on the S&P 500. It was the day before the payrolls report. Yields back then, 4.03%, the intraday low the day before on a 2-year. Right now, 4.83. That is an 80 basis point move in not even a month at the front end of the curve. And if you push that through the FX market, the outcome pretty obvious. We can take a look at euro dollar together right now. We've come down from 110.33 around that level back then to 105.64. We were on a 5-day weakening streak for the euro, trying to bounce there too, up 0.1% at 105.65, Tom. Euro weakness, the story of last week. And I think we get another read on CPI a little bit later this week. We'll get the German breakdown pretty soon too.
You have something I want to mention. It's off plot here as we go to Francis Donald, but I'm going to mention it as we consider the International Monetary Fund spring meetings. With the Nigerian elections, John, EM is fragile. And I believe the IMF has 4 global economies that are hugely troubled, and part of that is Fed interest policy. I'm sorry, Powell and these higher yields have an impact.
They don't want a resurgent US dollar, and we've had that in some places over the last month. You mentioned Francis Donald and Manulife. Here's a quote from Francis on the Fed. The Fed is in a terrible bind. It's entirely possible that growth is negative in 2023, but inflation is still above 3% and unemployment is still sub 5 as labor hoarding becomes a defining feature of the coming recession. That last piece, TK, is so important. The post-pandemic, or indeed the pandemic realities of this labor market.
It is, and what's important here is the way that Francis Donald constructs her note. John, it's hugely readable, and I've been in panels with Francis where the place just stops because of the concision, how she pieces C plus I plus G plus NX together is very dense how she does it.
The GDP equation.
Yeah.
Just to, just in case people
No, but she's doing it. Well, she leads with Econ 101 in her note this morning, joining us now, always lecturing on Econ 101. Francis Donald, Global Chief Economist and Strategist at Manulife of Canada and America. Francis, good to see you. Again, let me cut to the chase. We have a Fed in action. They are wildly ex post. What is the data after the fact that matters?
There's a lot of data that matters, but I suspect we're going to be moving away from the traditional, what is GDP, what is the unemployment rate, what is CPI? We're going to have to get a lot deeper moving forward. And that's because, well, the nature of growth and how the slowdown is impacting the economy is likely to be uneven. Yes, we are probably going to see a lower unemployment rate than we have in past slowdowns or recessions, but the composition of it will matter. Yeah. For example, during COVID, we had millions and millions of job losses, but they were in low-wage jobs that didn't hit GDP. In the coming, we might see those tech and finances having a larger impact. And inflation will be problematic because it's not about the headline number anymore. It's going to be about what segment of remaining inflation is interest rate sensitive or not. So unfortunately, that level 1 data is not going to be enough to tell the story or what the Fed's going to do anymore. We're going to have to work a little bit harder in 2023.
Explain the goods, services partition of inflation. Explain those two vectors as we look at the vectors to March.
Well, this one in some ways is straightforward. We know the unwind from COVID is going to push down on the goods side and services where you have that remaining component. But I'm looking a little bit further than that, which is right now we still have inflation that is interest rate sensitive. It matters. We're really pulling down on that excess savings, the demand side of the equation. But it's not so much goods and services that keeps me up at night. It's supply versus demand. And when we get to later this year, how is the Fed going to be combating the remaining inflation, which is food price inflation centric or geopolitical driven or ESG driven? We're going to have a moment, not just from the Fed, but from global central bankers. And I think it's going to start this year where they have to admit their ability to control that CPI number is waning, both on a cyclical factor in this year and next, but also on a structural basis.
And Francis, with that in mind, when they say we want to get sufficiently restrictive, what does that mean?
Your guess is as good as mine, John, but I think what they're looking for is more balance in the economy. And of course, they are getting it. They got a lot of it in 2022. Here we are talking about what does the landing look like? I'm looking backwards at 2022 and saying that looked like a landing to me. We had significant drawdown in housing, a bear market in the S&P. Did that not qualify as the significant slowdown? Now we're looking down, we're saying we're landed. The question is, do we hit the wall at the end of this runway? That's what we're focusing on moving forward.
What is the wall at the end of the runway? Recession, or the fact that you think they're going to have to accept a higher inflation rate?
Yeah, I think it's a little bit of the two of them, but it depends on your timeline. When I look at the wall at the end of the runway, what concerns me actually isn't 2 quarters of negative growth. It hasn't been for the last year. It's this concept of something we've been discussing internally, which puts a pit in my stomach, a concept like rolling recessions. Or when you look back in history, sometimes we see these periods of expansion downturns that fluctuate very quickly. Very difficult to manage money in that type of environment. And if we're heading into a period where GDP is oscillating around zero, slightly above, slightly below, we're going to spend all our time arguing over whether or not it qualifies as a recession or not focusing on the big story, which is we are not in reflation. We're much closer to stagflation. We are not in the roaring 20s. We're going to be in a slower growth environment with a lot of particularities that we have not seen in the past.
What is your when on this, Francis? I mean, we had Matt Lazetian from Deutsche Bank, who was brilliant on a delayed recession call. When is the when, not of recession or NBER recession, but what is the when of outright stagflation?
I heard that interview. I thought it was great. And I'm going to agree with Matt that it's towards the end of 2023 is the problem. And especially around June, July. This is when the year-over-year comps for inflation get a little bit trickier. And I'm concerned that's when the momentum in disinflation begins to pause out. And based on our traditional leading indicators of the economy, by the mid to end of 2023, that's when we're probably going to start to see the consumer and the jobs picture begin to decline. But at the same time, Tom, we do have to evaluate those leading indicators. Should we rely on them the same way that we have in the past?
Francis, I want to segue here over to your knowledge of Canadian macroeconomics. What can Jerome Powell learn from the Bank of Canada? I look at select developed nation banks, and they're taking a different path than the Fed. What's a lesson learned from the Bank of Canada for Washington?
Well, here's the challenge. In Canada and in many of the smaller developed economies, you have even less ability to control inflation with your domestic interest rates. And this is what the bigger bind for the Fed going into the next year is that if you're Australia or Canada, you're at the point where your impact on your economy from higher interest rates becomes much more severe, particularly because of the housing reliance, and your ability to control inflation begins to decline. So when I think about the Fed versus the Bank of Canada, what I see is a problematic situation where the Fed can tighten global financial conditions, but the Bank of Canada cannot. It's going to create a much bigger divide between these central banks moving forward.
I mean, John, this is what it's about. I set her up with that question to go to you. Imagine the Bank of England and what they have to do, or ECB, if Jerome Powell legs it out with inversion of 95, 100 basis points, with the 30-year mortgage going through to new high interest rates, with the Bloomberg Total Return Index moving down in price to under October level. What does that mean for the other banks?
They're all wrestling with similar issues, though. And I think, Francis, you've touched on it. The character of this new economy, that we might face labor hoarding. Can you work a little bit more on that, Francis? Just go through it piece by piece. The post-pandemic labor market realities, what are they, do you think, that just haven't been accepted just yet?
Well, let's keep it simple. Take a look at the employment to population ratio. What percentage of Americans are working? 40% of Americans are not working. Move aside the labor force participation rate and all of its equivalents. We're also looking at an economy where we have fewer people than before the pandemic. We're missing over 2 million workers. Where did they go? A lot of them retired early. A lot of them got fed up with this market. A lot of them are dealing with childcare and health issues. We have not come to the reality yet that our concepts of demand and supply for labor, for wages, may not work the same way our textbooks told us they did for the last several decades. So our new equations on how we evaluate what brings labor back to the market, I think those are going to have to change pretty significantly.
Francis, what is it, do you think, that brings labor back to this market?
Well, we know from history, if you make people poor enough, they will have to go back to work. But is that what we should be doing? And is that what central banks should be doing? And this is the big challenge I have when I hear central banks saying, we're going to reduce demand to bring it back into supply. But when you have supply shocks that are continuous, is really the medicine worth the cure in this particular environment? What is the role of a central bank? Control inflation and employment, or make the lives of the citizens of this country better? This is going to be a problematic question for central banks moving forward.
Francis, I think the next question further down the road, do you think politically that these institutions are going to come into some real trouble once people start to figure out, the electorate starts to figure out that their vote in the election is perhaps less important than what happens across the road at the Federal Reserve?
Well, we're certainly, I think, already beginning to see the challenges associated there, that when you begin to recognize what impacts your mortgage and how much things cost, that really that's more of a monetary policy question. We're all, not just the general public, but financial services are also going to have a moment where we realize monetary policy dominance, which has ruled so much of the way that we invest money and live our lives. We maybe see that challenging, especially because moving forward, the inflation in the system is likely to become less interest rate sensitive, not more. We're going to have a moment where we come and recognize that central banks need to do it, investors need to do it, eventually the general public will do it too.
Francis, we've missed you. It's good to have you back. And happy birthday for last week, because we didn't get to do this last week. Thank you. Francis Donald of Manulife Investment Management. One of the very best, Tom. Just going through some of the post-pandemic labour market realities, and I think that point there at the very end about this institution, the Federal Reserve, whenever they talk about demand destruction, Tom, softer demand, we need to bring demand down. What are they actually talking about? Higher unemployment, people losing their jobs? That's ultimately it, right?
I would suggest that demand destruction for so many of our listeners and viewers is housing. What a mess, John. You nailed this because you've lived it with the difference of British mortgages versus U.S. Mortgages. Year-over-year pending sales, 10 a.m. this morning. Look for Michael McKee, I believe, on that. The surge here, the gift from the Biden stimulus, was up 53%, and they've migrated on a pretty linear function down to minus 34%. I've never put a banner up like that on radio, folks. Year-over-year pending sales up 53 to minus 34. John, I've never done that in umpteen years.
This housing market is broken, Tom. This housing market is so broken from the pandemic interest rates.
And starting out west and migrating east, you wonder when it gets to us like it is out west right now.
What's the pass-through from what the Fed is doing to actually what's happening at home for a lot of people? They're just not moving, many people are. I think that's the issue. They're just not moving.
There's 4 or 5 issues, but yes, that is the new big issue. No,
I think we've got Darren Mayer in town. I think he's here in New York. Tom's
really?
going to sit around the table with us from HSBC.
Unbelievable.
Looking forward to that coming up from New York. This is Bloomberg.
Up to date with news from around the world with the first word. I'm Lisa Mateo. SpaceX and NASA scrubbed a rocket launch shortly before liftoff early today. The mission would have sent U.S. astronauts and a Russian cosmonaut to the International Space Station. Authorities blame a ground system issue. The next launch opportunity will be Thursday. Over the weekend, the world's top finance chiefs failed to agree on a consensus statement because of an impasse over Russia's war in Ukraine. The host of the G20 meeting, India, issued a chair's summary as opposed to the traditional statement. Russia and China objected to the wording on the war. That language had been cleared by all participants in November. Bloomberg has learned that Hong Kong may scrap its mask mandate as soon as early next month. Indoor and outdoor mask requirements may be removed at the same time, but masks would still need to be worn at high-risk places, including hospitals. The mask mandate is Hong Kong's last pandemic restriction. Only a fifth of businesses in the UK plan to cut jobs this year, even though the vast majority expect a recession. That's according to a survey from Boston Consulting Group. Meanwhile, more than half of the business leaders surveyed say they will keep raising prices the next 6 months. And Pfizer reportedly is in early-stage talks to buy Seagen. According to the Wall Street Journal, a deal would be expected to command a premium above the company's $30 billion market value. Seagen develops drugs to treat cancer and related diseases. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
I want to be clear, we are not yet seeing inflation going down to target fast enough. So central banks need to stay the course until we are comfortable that price stability is returning.
It's amazing to hear the IMF at the start of the year. Kristalina Georgieva at the IMF was talking there about how, start of the year is going to be tough, Tom. Recession, we're slowing down, Europe, US, China. And now the theme is central banks have to keep on going because inflation's not back to target. It's amazing what a month's worth of data does. Your equity market looks like this on the S&P 500. Futures, positive 0.5% on the S&P. We're going to talk FX in just a moment. Euro dollar topped 110.33, I think it was, day of the ECB. It was a Thursday, the day before payrolls, the same day that the two-year bottomed intraday. The yield then 4.03%. And Tom, I keep saying this, the yield this morning, 483. So that's an 80 basis point move. And as you can see, euro dollar's come down from 110 to 105 for good reason.
And they're correlated in, and I'm going to go back. If you're just joining us here, it's Wealth on radio and television. And John, I'm sorry, fixed income front and center. We said that last week, but it's even more emergent right now. And we're right near a true print of 89 basis points of curve inversion. I believe I've never said that.
Look at the chunk we've taken out of the S&P 500, Tom. We were up by 9% year to date, the day before payrolls, and now that gain is just about 3.5%, something like that, on the S&P 500. Cut it in half.
2 o'clock this morning, 2:30 this morning, we did get a print of a negative 90 on 210s. Which I stand corrected on that.
Been close the last couple of weeks.
Yeah, and the real yield up to 1.57 is not 1.30, 1.4. It's a grind. It's a migration here. Where are we at the end of this week with a delayed jobs report?
It's not just the US though, Tom, it's Germany too.
Yes.
So that print this morning, 10-year, highest since 2011. 10-year this morning, 256. Just amazing to see the front end of the German curve with the 2-year piece at 3%. Just think about where that's been for the bulk of the last decade, Tom, sub-zero. And now we're at 3%, and having a real conversation about the ECB taking rates to something close to 4. That's not what I imagined or anyone imagined maybe 6 months ago.
Well, we're going to get briefed on it now. We've got a great set of guests coming up here. Alberto Gallo, for all of you on Global Wall Street. When is that, John? The beginning of the next hour?
Next hour, 20 minutes.
Alberto Gallo with us in studio. We're thrilled to bring him to you this morning. And now an important guest. John, I want you to bring him in because, you're the only one who understands. Watford's a gap, right? It's north of London.
You're going to get
and
yourself
it's like
in.
the Grand Canyon.
You're going to get yourself in trouble.
It's a gap,
there is
right?
a gap. Yeah,
it's a gap.
But that's not what Watford is.
I want you to bring
very, very clear.
Watford in the gap here as well, because the real gap here is Darren Myers writing foreign exchange, but he's reading Steve Major. That's the gap right now.
From HSBC. How important is Steve's work? And good morning to you, Darren.
Not as important as Watford Football Club. Can I
Clearly,
just make that clear?
Clearly Thanks
Tom.
for that clarification.
No, look, it is vital. It's interesting your intro to this segment. That it's just been a bizarre start to the year. I mean, I remember at the start of the year, people were saying, you got to buy the dollar, US is tumbling towards recession. Last week, they're telling me, you've got to buy the dollar, US is exceptional, it's just knocking it out of the park. And you do sense that next week, if we get pretend we get a soft payrolls print or a soft CPI, it'll be like, oh my goodness, the Fed will have to be cut rates by June of this year, and what were they ever thinking? And it's this fondness in the market for nowcasting. Let's take the most recent piece of data and extrapolate it for the next 9 months, and that's where we land, and that's what we'll all talk about as being a certainty. We've taken a different approach. We've said we don't have a clue. I mean, the market collectively does not have a clue at this point in time. Hence, we're going to get a choppy market, and that's exactly what we're getting. We're getting massive swings in interest rate expectations.
Can you bet on this? Can you establish trades on this? Can you speculate in this market?
Yeah, I think you can respect the range, and this is something Steve Major has said about, US bond deals. It's not like necessarily we have to have this huge directional call in the short term. You respect the ranges, you can make a lot of money. You can make a lot of money in soccer betting on a 0-0 outcome. You don't have to bet on 4-0 wins or 4-0.
Sheffield killed you.
I know, I'm used to that. If you follow Watford, you're used to getting killed.
Is that the Def Leppard team? Is that the one Joe Elliott loves?
I think it might be.
Okay, thank you.
I like the fact that every football team has an association, some cultural association.
That's the only way to keep up.
We should go Elton John if we're going Watford.
Yeah, Elton John and Watford. That's a much better one.
It's a much better one than Watford Gap.
Of course, come on.
I'm learning every day on surveillance. That's what I know. What's your trade right now within a collar or a range-bound market like this? How do you construct a speculation?
Honestly, I like the DXY dollar index has pushed towards 106. It's been 100 to 106 a year. We're getting towards the top end of that range. It might feel brave to say, I think we got to respect that range, but I think we do. And so I think I can see us retracing lower on that. Against what? I mean, Euro is a candidate in that context. Maybe sterling, maybe yen. But I think if you're going DXY, then you've kind of, the other side is you got to be euro dollar correcting higher.
Okay, there it is, but that takes out the EM component. Bloomberg Dollar Index has the EM component.
Yeah.
As an obscurity, I see Argentina peso, one of the IMF's big headaches, out to a 196, black market pushing out near 400 pesos. Is EM falling apart where you can make a speculation there?
EM, it's interesting. EM is, we can talk about G10 ranging. It's more difficult to make that view on EM. I mean, there are some key levels that have moved on dollar EM. I'm not sure I'd really call that Argentina as being kind of my barometer of what EM is doing, though.
It's Monday morning TV. Stay with me.
I know, it makes for good headlines, but...
The China story is the important piece of what's happening in EM for a lot of people. What's your read on that reopening at the moment?
Well, look, it seems to be heading the right way, I would have said. I mean, we've navigated the Chinese New Year. It seems without some massive dislocation in terms of mobility data. And it's interesting, again, you think about the US part of that equation and the China part, and even Europe, US exceptionalism, even European numbers are better than expected. Have we already forgotten the PMIs last week? They were pretty good on services. So, I think things are, there's this, I know you had the Deutsche guy on, and he was talking about this late recession, but I think the reality is most of the numbers are stacking up towards a second half recovery. That second half will show more momentum than the first half of the year. And I think China will be part of that. So I don't want to over-dramatize what we're seeing at the moment. For the most part, activity's coming in a little bit better than expected. Inflation has not been great. It's too high, but it has been coming down.
To your point, though, I think in FX we're better at dealing with extremes. You started this conversation by essentially describing the dollar smile, the two sides of it.
Yeah.
Things are either really great, dollar strength, or they're really bad, dollar strength. Are we somewhere in between then for you?
Yeah, well, we haven't really... how would you say, got to the bottom of which we should be how we should be thinking about the dollar. Should we be trading it on the basis of US exceptionalism or US recession? And one piece of data is going to point one way, another piece of data is going to go the other, and we're going to flip when we're in the middle ground. And, that's the dollar chop. You have to then step back from the noise, which is what currency markets are dreadful at, because we love to say, what's it doing until lunchtime? Right, it'll be doing that for the rest of the week. I think we have to step back from the noise. If you step back from the noise, what is the pattern? Inflation is slowing, perhaps not back to target, but it is slowing. Activity looks like it is set to recover through the second half of the year. The forward-looking indicators are looking healthier. what does that mean? Well, that's constructive for risk, and it's a headache for a cyclical or a counter-cyclical currency like the dollar. So medium term, you got to think that this chop will be followed by the flop, and that's been our view.
Are we a victim of recency bias, though, which is what I'm assuming you're suggesting, or are we just waking up to the fact that this data is just good?
Okay, there's two. You have to avoid the recency bias, but you also have to be mindful that is the data turning? You know, are we at a situation where the U.S. economy is going to show renewed tightness and renewed price pressures? You know, used car prices have been mentioned as one thing worth watching. But all you can do is what the Fed has said, which is let's look at the data. It feels like the bar is pretty high at the Fed to re-upping the pace. So then it becomes a question, well, how often do they raise rates by 25? And I think that's a fair debate to have.
Overlay, Steve, very, very quickly here, overlay Steve Major's historic call of a lower rate regime into where we stand this morning. Does HSBC stand with an historically lower rate regime call?
Yeah, I still think it makes sense. I still think it makes sense. You know, we are heading towards a period where we should have disinflation and decelerating inflation. We still have all the structural elements that Steve likes to talk about as remaining in place, and that will continue to weigh on yields. But, you know, you got to see where the mini cycle is within that, and that's fine. For now, it's putting upward pressure on yields, and it's translating into some dollar strength. But again, let's not get caught into taking those last 10 data points and extrapolating out a year.
Darryl, this was great, as always, just a clinic.
Do you think, since he's moved to New York, do you think he's more cynical than he was when we used to meet with him in London? I think Darryl's changed.
No, I don't know about that.
I've just got older, Tom. I've just got older. It comes with age, not geography.
Oh, okay.
As you get older, you become more cynical.
Yes. No.
What's your experience of that, Tom?
No.
Darryl, thank
More
you.
cynical, more
I had no idea Darryl was a Watford fan.
I didn't either.
I am that one.
There's a gap
How did that happen?
in my knowledge.
It was misguided youth.
Can you, like, see the gap?
Yeah,
Is it
you
like
can.
a
Yeah,
canyon?
people go there. They go there and have a
see
look,
the
and
gap?
they take pictures.
Yeah.
That's
Forget
exactly
Buckingham
what
Palace.
happens.
Everyone go and see Watford Gap.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy. But
Because-
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have
I've been in and seen it.
lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
destination is clear. Ultimately, the Fed wants to orchestrate demand destruction.
There is a very strong signal coming from those leading indicators. That's too hard to ignore.
U.S. equities stand perhaps in a little bit of a toughest spot. A lot of our clients are just kind of waiting it out. They didn't buy the January rally. They're still licking their wounds from last year.
Markets look expensive. Earnings expectations look high. So you have this whole bearish narrative. I call it the bearish truck, and it's coming.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The bearish truck is coming. Is that on Monday morning? Good morning.
Sounds like something Bramo would say.
The bearish truck is coming. Bramo's going to be bangers tomorrow. Should pick up on that, no doubt.
We're
From New York
gluten-free.
City. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Futures positive 0.5% on the S&P 500. Last week, dreadful, Tom. Biggest weekly loss of the year so far on the S&P 500.
The dreadful continues. My phrase for today is the vectors of March. Like it's like the Ides of March.
Nice, that
Very
works.
Julius Caesar salad.
Yeah,
okay, great. So we're doing that, and the answer is it's the vectors of March, and the vectors of last week continue in this week. But John, I'm going to call it with an accelerating tendency. You get 2's 10s out to 89 basis points, which is basically a new low. Did you see that headline 2 hours ago on German 10-year?
High since
I mean,
2011.
I'm sorry. If you're in the U.S., folks, you're at a point now where you have to really pay attention to European yields, which is why our guest coming up here is someone people need to lean forward.
The month so far, Tom, this 2-year yield, the 2-year in America just punching everyone in the face who's long equity risk. 483. That's a problem for a lot of people, and it's been a problem over the last month.
You know, are we scoping out I got to get this up here. I'm sorry, I failed, John. I don't have it up here right now. But you know, you got pending home sales today. Case-Shiller tomorrow. There's some confidence data. John, important for you. March 1. You care about ISM. Does the Fed care about that first look of March?
Oh, without a doubt. The first look on February.
Particularly because jobs is ancient.
We want to work out whether the January data was a head fake or not, and was it confirmed by what we see in February? And that's what we're going to see from that ISM, just a sneak peek of that. But ultimately, you've got to wait for payrolls. That's not this Friday, that's next Friday. And you've got to wait for the next CPI read, Tom, going into the Federal Reserve when they meet. And they give us a new set of projections. And you'd have to imagine that that dot for 23 is going to shift higher in that set of projections they put out at that meeting.
The simplistic idea for those keeping score, I want one number. It's this terminal rate derby we're in. I really didn't pay attention to it when we were ultra accommodative and all that. Bramo's on her phone looking at it every 5 minutes.
Do you remember the Bullard dot in that dot plot? Just sort of like there, along the bottom.
But now it matters because we've gone from ultra accommodative to accommodative to now some form of restricted. And then what? In this week, this screen is telling me we're going to model out an ever more restrictive terminal rate.
I said this in the last hour. 12 months ago, the Fed was doing QE and rates were at 0. So that just gives you an idea of how offside they were going into 2022. Equity futures right now are positive by 0.5% on the S&P 500. As I said last week, dreadful, biggest weekly loss of the year so far. 3 straight weeks of losses on the S&P, the longest losing streak of 23 as well. Yields now unchanged. We're a little bit higher, still close to 395 on a 10-year. Let's call it 394, 395-ish. In the FX market, euro dollar trying to find a firmer footing after declining every single session of last week on euro dollar. Now positive 0.1% at 105.64. We've got a special guest in the room, Tom, in a studio over from London. Let's get straight to it. Alberto Gallo, the co-founder and CIO of Andromeda Capital Management. Alberto, welcome, sir.
Good morning.
It's good to catch up. It's been too long. I know that you're up on the year. Single digits, is that right, in the fund? And I know that's because partly of what's been happening in the rates market. You were short. You were looking for higher rates. You've been thinking about a higher terminal rate as well. What's been guiding that view through the year so far?
Look, the interest rate was 0 just a couple of years ago, as you said. And everyone thought monetary policy was the only game in town. This is now about fiscal policy. We're entering the fiscal policy decade. There's one word that you never hear about, and that's austerity. No government in the world is talking about austerity. We're in a wartime economy, and governments are spending at 5%, and that's the inflation generator. So the moment you see fiscal policy waning, the moment you see, governments stopping spending, then you'll see lower inflation. But today, even with very high debt levels, we still see government spending at 4 or 5%. And that's going to the bottom 50% of the distribution, and that's driving inflation up. So we see the Fed still not doing enough. The Fed needs to go towards 6%, perhaps even higher than that. And the yield curve is too complacent in pricing this temporary high interest rate environment. We're really here for longer. So higher for longer is where we're going.
So you think that view at the front end should be pushed further out along the curve? How much further out?
That's right. And over the last few weeks, we've seen the 2-year and the 3-year starting to lead the widening. So, we need to see the 3-year and 4-year part. So the belly and the front end pricing higher here. It's not just the 1-year or the 2-year. We're not going to necessarily get cuts, in 2024. Who knows? But we're definitely not getting cuts this year.
Is now a time for safety and quality, or are you comfortable buying distress?
So the consensus has been, yields are high. They might not be here. Why don't you buy investment grade debt? But the reality is the spread on investment grade bonds is pretty tiny now. It's, it's below 100 basis points. So you might as well buy treasuries. And then when you have conviction, you go into a high yield high yield bonds, and you get those double digit coupons that are really compensating you for inflation.
I'm just asking for a friend. I mean, I'm looking at the Aston Martin 10.5s of 2025 here. And folks, these have gone from 110, bonds aren't volatile. They've gone from 110 to 90, back up to 99. I mean, I'm asking for a friend here, does he need to slide into these before Bahrain?
Yes, is a short answer, but look, the most important question.
Take the next question. I got to get my phone out here.
Go on now, Bex.
Yeah, I'll take 20 of those.
I think the biggest question here, the most important question is, are we going back to the pre-COVID world, or is it a different world? Are we going to have...
This is key. What's a different world look like?
So the pre-COVID world was monetary policy all in and low taxes. And today we have stronger fiscal policy. We have high taxes and high spending, and it goes to the bottom 50% of the population. So we have, and even in Europe, even Italy is spending at 4.5% this year, despite having, very high debt levels, 140% debt to GDP. So this creates inflation, and it's not going away. And so you're in an environment of state capitalism. Governments help companies. You want to be short government debt because governments are, increasing more and more their load of debt, and you want to be long corporate debt in strong countries. Sometimes it's better to be in a weak company but in a strong country than in a strong company but in a weak country.
Well, let's put some meat on those bones. Does that mean be long the national champions at Germany? Do you describe Germany as a strong country? Is the US a strong country?
Definitely, there's countries that can spend. So in the developed world, generally, there is room for fiscal policy easing or continued fiscal spending. And the companies that benefit are not necessarily just the national champions, not just the investment grade companies. Yes, Telecom Italia got help in Italy, but it's also Burger King in France. It's also some of the high yield firms, some of the retailers, they all got help. It's TUI, a holiday maker company. So there is, it's Finnair, the airline in Finland. So there is a lot of names, a lot of firms that governments cannot let go. And in a state capitalism environment, you're betting on the survival of the companies.
Tyler Brulé at Monocle, his favorite is Finnair. He says that's a single airline of Europe that's figured it out.
Year to date,
I have no idea.
Year to date, those equities have been flying on the airlines.
Brulé is
I'll bring up those scores
they're
in a moment.
the winner.
Alberto, what you're saying, though, I don't think a lot of people will be able to get their heads around. You're saying that we can be short core government bonds, we'll get those higher rates, but you don't think they're going to damage corporate credit?
No, they will, but they will damage emerging markets. They will damage the weakest high yield firms, and that's why you want to be active in the market. You don't want to just be all in. Not right now. We're going to see more vol, but ultimately there are some companies that have a cushion, and those are the ones where you want to be, and you get paid today a pretty good return in those firms. So we're cautious. We think that we have higher terminals, financial conditions are still loose. No one got hurt yet. Crypto was deflated. There was the LDI crisis in the UK, but no one really got hurt yet, and that's why the Fed's not going to stop.
My book of the summer is Olivier Blanchard's monograph. He totally agrees with you that this is the fiscal decade, that all of a sudden fiscal matters. You're expert at finding opportunity in full faith and credit fiscal. Which country are you studying the most right now?
On the long side, we like Europe because we see a stronger fiscal policy support. But emerging markets are where you want to be really cautious, because with a stronger dollar and more geopolitical conflict, you have countries that are on the brinks. There's been already some defaults, but this year you're looking at elections in Turkey. You're looking at more instability in Egypt. So emerging markets have been the trade of the last 2 decades, and they're much weaker now, and it's not coming back. So we're going to see more defaults there.
I mean, I look at the IMF meetings coming up, and it's once again IMF to the rescue. Do you think it's so emergent right now in Nigeria, in Egypt, in some of the other, Turkey obviously, that you just have to step aside and wait?
IMF is rescuing these countries, but obviously the bondholders are subordinated, and maybe in the future we'll need a different mix of funding. Like there is a recent quip by the one of the sub-Saharan countries saying, 10% interest rates are the kiss of death for us because we can't sustain them. And so if interest rates are constantly high, which might be the case with fiscal policy and persistent inflation, then you gotta find a different capital structure for EM countries. And restructuring is much easier for sovereigns than it is for companies.
Just to finish up with the Treasury market, you made a call that the move at the front end needs to be pushed further out along the curve. As you look at the curve right now, I've got a 5-year at about 4.22, 10-year at 3.95. What are the levels that you and the team have got in mind?
We need to see the 5-year above 4.5%, more towards 5. We could see the boom towards 3. Definitely, BDPs have been in a complacent world here on the 10-year with Italy spending. So, we're just at the beginning of the year. There's been a lot of demand after last year, and everyone said, bonds cannot be down 2 years in a row, but, we're in a different world.
So what I hear from you is that you don't think this year is the year of the bond at all?
Not yet. It really takes very active approach here, and our process is about screening the opportunities, not being beta focused.
Is this the year of the AC Milan?
It better be. It better be. We won yesterday 2-0. We'll take that. Yeah, right. Then I think we've got a return leg with Spurs in a couple of weeks' time.
It is.
We're doing more Formula One through the week. Can you believe he's not supporting Ferrari? He's supporting Aston Martin.
Well, no, I have to. Okay. I think Fernando's there. Come on, you got to go with Fernando.
Hey, Fernando's
a last
legend.
Year.
We really let Fernando down. Ferrari did.
Yeah.
We should have given him a championship-winning car. We came very close with him a couple of times.
Mr. Stroll of Canada is providing an anchor.
Alberto, thank you. This was great. Alberto Gallo there of Andromeda Capital Management. Equity futures right now up 0.5%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. British Prime Minister Rishi Sunak and EC President Ursula von der Leyen meet today. It's a signal that two sides are ready to settle their differences over Northern Ireland. Finalizing the region's post-Brexit trading arrangements has been an issue since the withdrawal agreement was reached in 2019. Saudi Arabia has signed agreements worth $400 million with Ukraine. The kingdom's foreign minister made a surprise visit to Kyiv and met with President Volodymyr Zelensky. Last week, Saudi Arabia voted for a United Nations resolution calling for Russia to pull its troops out of Ukraine. A U.S. government investigation reportedly has found that a laboratory leak in China most likely caused the COVID pandemic. According to the Wall Street Journal, a classified report on the Energy Department probe has been provided to the White House and key members of Congress. The Journal says the department made its conclusion with, quote, low confidence. A fresh wave of layoffs at Twitter to trim costs. The nationwide cutbacks included teams from engineering and product. Sources tell Bloomberg some employees learned they were laid off via an email late Saturday, while others found out when they couldn't log into the internal system. It's unclear how many workers were impacted, but insiders say it could be dozens. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
PSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit pso.org/now, where the music plays on. PSO season sponsor, Bank of America.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
My intention hasn't been from the beginning to run, but there's too many other things I have to finish in the near term before I start a campaign. It's legitimate for people to raise issues about my age. It's totally legitimate to do that. And the only thing I can say is watch me.
It was the President of the United States, President Biden, in an exclusive conversation with World News Tonight anchor David Muir here in the United States. Tom, that's a question that's going to come up repeatedly, particularly if he does announce formally that he's going to be running in the next election.
It's the way it comes up, and we're going to go to Anne-Marie here in a moment, who's been really gracious about this, and it's a unique thing. What I would really point out, John, is the uniqueness of it is almost an American thing. I'm not even going to equate the Chinese or the Japanese, where that maybe there's some Asian nation I'm missing in my Monday morning brain, but I'm stunned at the youth of the Baltic states, the youth of Finland, the youth, frankly, of England, of Mr. Sunak and the rest. I mean, it's a unique American path.
And of the Republican candidates that are set to be on the ticket as well, Tom, potentially. If you look at Nikki Haley being one. The Nikki Haley one's interesting. I think Politico did a story on this in the last week or so. I think a lot of people believe there should be a new generation, but is she isolating the older age cohort of the Republican base? Is she isolating them when she says we need things like competency tests for people over a certain age?
Yeah, I mean, that was very controversial as well. And I think, in the zeitgeist this morning, and I think Maria's playing it up over at Fox Biz, is Mr. Trump still does well in the polls. I mean, it's
tremendously well.
Hugely fervent for our international audience now. This is Lisa would say, it's a stew.
Well, Tom, if you get Haley, DeSantis, Pompeo potentially,
six others
Pence
at least.
maybe,
They're all going to
a handful of other competitors. They just dilute the vote. You get the Trump vote, and then you get kind of everyone else spread out.
Yeah, but they're running for cabinet. I mean, in my camp, they're running for cabinet positions, and somebody's running for VP.
Oh, you think they are?
Oh, yeah, absolutely.
But whose administration?
I don't know. Well, I don't know.
Because they had pledged not to run against the former president, and now Nikki Haley
is. I just wish we ran it like you guys. I mean, I think
short, to the point, fast.
Sensible. Futures up 21. The VIX. What else do you see here, John?
Yields look like this on a 10-year. Let's call it 3.95. We had Alberto Gallo on in the last 10 minutes. Just absolutely fantastic. Talking about maybe a 5-year that needs to push 5%. These are just unbelievable numbers. This came from Apollo's Torsten Slok over the weekend, and this speaks to what Alberto was talking about. Just fiscal policy. Using CBO data that shows interest rate payments on U.S. government debt, they've doubled from $1 billion per day before the pandemic to now $2 billion. That was Torsten Slok over the weekend, from $1 billion a day, Tom, to $2 billion.
We're going to start to see a lot more of that, particularly if we break through to new higher yields. Right now, we're going to break through to 2026 with Anne-Marie Horton, our Bloomberg Washington gerontology correspondent. Anne-Marie, here's the way it works. If you're a two-term, well, I know, you're laughing at me. I mean, you're telling me this all the time. Anne-Marie, if you're a two-term president, basically, your second term ends at the midterms. This gets President Biden out to 2026, and he will celebrate his 4th birthday right after that election. How do they adapt and adjust to that reality?
Well, they are adjusting to it in the sense that the president says he's open to people questioning. You heard him there in that interview with ABC News, questioning his age, but says, watch me. I mean, it's a matter of time now before he just officially announces he's going to run. And I think this question about age, whether or not it's the current president, Biden, or the former president, Donald Trump, who's obviously going to be running, is really for the American people to decide.
There was a style of presidency where the president would sit back. Mr. Reagan was very comfortable with that, I would suggest. And then there's been a more modern style of literally White House micromanagement. We can talk all day about that. Do you see a trend here where President Biden is stepping back and delegating authority and decision-making?
At the moment, no. The president is very hands-on, and what you hear about him is that he wants to hear every single detail of an issue before he makes a decision. But potentially, if he was going to have a second term, and given his age, that maybe he would be delegating more. I think it probably depends on the circumstance and the issues at hand. But I mean, I think this weekend really showed that not only from the president sitting down with ABC News, but Dr. Jill Biden, the First Lady, her interview with Associated Press, when she said, how much more does he need to say it before you believe him? And then she was asked, is it just now about a time and a place? And she said, pretty much. And then their granddaughter tweeted, preach, Nana. So it's pretty obvious that the current president, Biden, will be running. We're just waiting on details of when he wants to make that announcement.
I think we run the risk of getting a little bit too far ahead of ourselves by discussing the nature of the next administration. He's got to run, and he's got to campaign. Yeah. And Anne-Marie, we have to talk about what didn't happen in the last election. The current president was able to make it a referendum on the former president, Donald Trump, and he didn't really campaign that much. Do you think he's going to be able to do the same again?
No, he's going to have to be out front campaigning across the country if he was to make this bid for 2024. And the president talks about that. He's like, I'm not ready to start a campaign. There's still a lot of work I need to do in the current administration. So then you'll really have an incredibly busy White House, right? You'll have a lot of people that need the president's time for issues of the day. But then, of course, the politicals in the room wanting him to get out and talk to the American people.
Have we given enough thought to that, Tom, that we could have, based on the probability right now, the odds that you just went through, just another face-off between the former president and the current one?
Oh, I haven't looked at the numbers. I mean, I don't think it's our purpose to look at this. That's what Anne-Marie's expert at. But the answer is yes. And there's a history of that in America. This is not original. This happens. And I'd suggest in British politics, the way Churchill came back 15 times, I mean, they endure, don't they?
Well, you think the current president, based on what we're hearing, would prefer to run against Donald Trump relative to some of those other candidates?
I think any Democrat would prefer to run against.
What's interesting about this, Anne-Marie, when you go through the head-to-head of the current president versus the former president, Biden's still right up there. But when you ask Democrats who they'd like to run and be their candidate, he isn't. Can you work that out for us?
Well, there's a lot of Democrats who are concerned about his age and do want this generational change. But many would also be honest and say if it is going to be a rematch of 2020, that Biden is likely the best person to beat the former president. But we should also talk about this wide Republican Party in terms of the primary. DeSantis enjoyed the most support among 9 potential GOP presidential primary candidates in a recent WPA intelligence poll. So this survey shows that he's backed by 40% of respondents compared with 31% for Trump. And a few months ago, there was a Suffolk County poll that talked about the fact that, yes, Biden would beat Trump, but those numbers become much more difficult for the current president if he's facing off the Florida governor.
The other issue as well, AMH, that I think is going to be difficult for the current president, and many other people are saying essentially the same thing. In the last election, he was able to be the other guy. I'm going to unite the country. I'm not President Donald Trump. And some of these centrist, maybe center-right Republican voters may turn around and say, you know what, that might be the right direction for the country. How do you repeat the act, given the way he's governed over the last few years?
I think what will happen is this administration will try to tout their legislative wins, whether or not it's in foreign policy in Ukraine, which right now that is a big divide within this primary camp, or whether or not it's their legislative wins like hard inflation, which they were able to get bipartisan support, or the CHIPS Act. And then they're going to point to issues that the former President Trump is talking about and still say, do you want to go back to that quote-unquote chaos of those 4 years, or do you want us? But it makes it in a much difficult position than they were, say, in 2020.
It is February 27th, Tom, and we're going to be doing this for another 18 months. Just amazing.
Nothing for America to be proud of.
AMH, thank you, as always, down in DC. Some people think, Tom, the process is a long one. It puts the spotlight on enough people. You get to find out what they're really about in a way that maybe you don't in shorter elections. That's an argument against that.
It comes to me down to the history of states' rights, and that the states have a right to hold a primary, et cetera, et cetera. And it's just that simple. Every state wants a primary. Everybody wants. You get a date calendar set up. We used to have the date calendar when I was a kid, but it just didn't seem as painful. Part of it's the media scrutiny.
You think it's because, as Darren Mayer said, as you get older, you become more cynical?
I think that has a little bit to do.
That's what it might be about. Futures right now on the S&P trying to bounce. Last week was ugly, up about 0.5% right now on the S&P.
I can't get Elton John likes Watford.
Yeah, apparently. Yeah, Tom Hanks likes Aston Villa. Never got my head around that. Yeah, he was at the game the other weekend. Can't figure that out either. 10-year yield higher by 2 basis points, 3.96.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Equities up here to kick off the trading week. Good morning to you. Equity futures up 0.5% on the S&P, on the Nasdaq up 0.5% also. A lift after last week's losses. In the bond market, a 2-year yield higher a little bit earlier this morning. We take some of that away. Still high by 2 basis points though. 483.85 on a 2-year. A closing high on Friday that we haven't seen going all the way back to 2007 at the very front end of the yield curve in America. Torsten Slock of Apollo published just moments ago. The Fed is now so far away from its dual mandate that the FOMC may not only consider using more hawkish forward guidance and raising the Fed funds rate, but they could also, Tom, accelerate the rundown of their balance sheet. That's Torsten Slock there, just introducing the idea that maybe they do a little bit more QT, given what we've seen in the data.
I'll take the balance sheet point, though, as well, but it's just where we are versus weeks ago and certainly months ago. John, you've been very good about showing the migration of the 2-year path. We get a 4% 10-year, that's going to be a big deal. But Slock goes into the Taylor rule, which is a complex measurement of where we ought to be. And we spent a lifetime of Stanford students with Professor Taylor not doing the Taylor rule. And right now, Slock's mathematics is just under 10%. Is a Taylor rule. That's shocking.
Well, the Fed's had to. The Fed's had to change.
That shows how out of whack we are.
I've mentioned this a few times. If you go back to the December 2021 summary of economic projections from the Federal Reserve, they had year-end 22 at 90 basis points. That had to be revised, and then it had to get revised, and then it had to get revised. And Tom, we are still revising the terminal rate higher, and they're set to do the same thing again at the next meeting.
I mean, it's Monday. We don't do equations on Monday, but you know, you got the Taylor rule estimate. One quick look at in the Bloomberg is 11.7%, and it's the neutral real rate plus inflation plus alpha, beta, gamma, the rest of it, and they throw in the Oken factor. All you need to know is the difference between where we ought to be, according to Mr. Slock, and where the Fed rate is as wide as any time I see, including coming off the great financial crisis. I didn't know that.
This story's moved so quickly, TK.
Yeah, today. Exactly.
We started the year, and I talked about this a little bit earlier. Thanks for that. You had the market down here, the Fed up here with its dot plot, and we were all talking about how do we close that gap between the Fed and the market. And now the market's above the Fed, and the Fed ultimately at this next meeting, Tom, is going to revise that dot higher based on the information we've seen so far. But I will say this, if we see confirmation of the January trend in the month of February, we will have another payrolls report. We will have another CPI report that the Fed can ultimately take a look at.
You remember that ugly day like months ago, long time ago, 10, maybe 13 months ago, where they tested me for equity movers?
You doing that now?
And they just like, one guy fell off his seat laughing. It was such a train wreck.
You're doing stocks now?
I'm doing stocks.
What have you got?
Bramo's not here. Can we do an equity mover?
What are we looking at?
We're going to have Sri with us here in a bit here. And I'm sorry, Goldman Sachs is this week's equity mover for Global Wall Street. Fortress Solomon, there's some real mystery here. I mean, Mike Mayo in the story is pretty scathing, looking for what Mr. Solomon and others will say in the Goldman Sachs Roadshow investor meeting.
Investor Day tomorrow, yeah?
Yeah. Are you going?
No.
I wasn't invited.
For good reason.
Excuse me.
What would be your question for Mr. Solomon right now?
My question is, how are you going to exit your commercial bank effort, even though it's a small part of the company, to assuage your partners?
Oh, there's an assumption there then. You think they will? And it's a matter of how?
I think it is an assumption that he has to speak to the management and the heritage of the company. And I'll take Mr. Solomon's point. What we're arguing about here is a small part of the bank. I believe Sri's with us here in a bit, but did I do okay on my
That was perfect.
Mover?
Sri's going to be with us in about 10 minutes.
I can't pronounce NVIDIA either, so, you know.
Goldman's up this year by 6%. If you want a comparison, I don't know if you think Morgan Stanley is a comparison, but it's a decent one. Morgan Stanley's up 15%.
We'll talk to Sri about it. Price to book. Gorman wins, Solomon, 1-0.
Yeah.
Gorman wins, Solomon has some answers, and we'll talk to our Goldman Sachs expert on that here. Right now, we're going to talk to the bond market expert. Katrina Dudley joins us with Franklin Mutual. Just a really, really wonderful global take as well. Katrina, you depressed me. In your opening paragraph, you announced that baby boomers, the youngest baby boomer is 59. How does that demographics fold into a long-term investment confidence?
Well, we're looking at the wage
spiral, and we're looking for workers to come back into the workforce in order to address the fact that our unemployment is extremely low, despite the Fed having made some significant rate hikes and trying to kind of cool the economy and cool that inflation number. And don't forget, inflation is somewhat of a catch-22, because if we have inflation and then we need to pay our workers more in order for them to be able to afford goods and services, that increase in wages then feeds back into that inflation spiral. So we either need productivity, or we need to get more of those workers back into the workforce. And that's where the baby boomers come in, because the 59-year-olds are actually now starting to retire.
Do we need immigrants from Australia?
I think Australia is facing the same problems as the United States. We're trying to keep as many of our workers in the country as we can, because a lot of the same trends that are impacting the United States are affecting other countries. And that is the fact that we've had such access to the Chinese workforce for so many years that companies have just taken that for granted. As you say, we are now in a situation where companies are really struggling to get workers.
I would suggest in the recent data, always dated, that we saw some enhancement of productivity. The adults in economics make real clear we must see a durable productivity enhancement. Do you at Franklin Templeton observe that?
I think that the problem is that productivity is a very much a lagging indicator. At the moment, we're really suffering from the fact that to attract workers in, we're having to spend so much time training them and bringing them up to speed. You look at things such as the supply chain, just bringing online a worker who can drive a truck. You can't just put someone in a Class 8 truck and expect them to drive it. They can't do it. They need to be trained. They need to be certified. And all of that training is a drag on productivity. So I think that even if we have in place a lot of metrics to improve it, it is going to take much more time than we expect. And the risk is, as we talk about earnings, is that this is the risk to margins that we see, is that the fact that you've got these higher worker costs, and if you've in a company, you may not be able to pass that on or sufficiently pass it along in terms of pricing, which will compress your margins.
So Katrina, when you look across the equity market right now, is there a sector, an industry group that is more labor intensive, so to speak? Is there a place in equities you want to be and don't want to be with that in mind?
When I think about the labor equation, the easy one to put out there is a services economy. So anything that is very highly geared towards services is obviously overly dependent on workers. But the way we think about it is somewhat different. We look for companies that have really got a great history of treating their workers well. And the reason is that they are going to be magnets for workers, and that's going to give them a competitive advantage versus other companies that haven't done that. And you can see that dichotomy within industry. And it's the reason, I've been an active stock picker my entire career, and it's a really exciting time because these are things that, quant models cannot capture. You need to be out on the ground talking with management teams, understanding their culture and understanding those factors.
Could you give us a specific example of that, just so we understand it a little bit better?
I think one of the examples that we've seen is some of the rail companies haven't been great in terms of the way they're treating their workers. And as the economy has ramped up, they've had a really difficult time, some of these rails, being able to capture those benefits because they just don't have enough workers. And in terms of the rail industry, there's regulatory constraints that mean you cannot run a train unless you have an appropriate number of workers. So this is a great example where, they thought that these people that they laid off would come straight back, and they're not. They're going to other jobs.
Katrina, to your good point there on active management, with the turmoil that we have coming off of COVID, is your choice set smaller? Are there fewer things to pick from? And do you need to be less diversified, making larger sector bets and frankly individual stock bets because you're constrained by choice?
I have to tell you, Tom, we do not bet in equity asset management. We do the research, and it's the one term that I tell all of my analysts to please just take out of their vernacular, because we are going in there, we're doing the research, and we're understanding the company. So I just have to start the answer with that, because it's something that really frustrates me, that people think that we're betting with their retirement savings, and we're not. As I look, though, at the companies that I want to invest in, I am looking for strong franchises. I'm also looking for companies that have got factors that will help them get pricing that are outside of just cyclical factors. So, for example, look at the industrial space. You can take a company where the industrials have got the electrification trend, which is a tailwind. They've got a lot of government money that is coming into the industrial space. We've underspent on CapEx, and so you just have all of these structural tailwinds, which are drivers and will also give them the pricing power. Having that pricing power means they can take care of their workers and protect their margins at the same time. So we like that type of setup.
I mean, I look at the type of setup here, and I get it that it's a 3 or 5 year hold. Do investors have patience for a 3 or 5 year hold anymore?
I think it's a competitive advantage if you do have investors that have that 3 to 5 year picture, because you need to be able to invest through this cycle. So, for example, you may have companies today that are investing in their workforce, and if you believe that they're doing that to position them for 3 to 5 years, also a number of these companies have invested in trends that may not bear fruition and for a couple of years. So, for example, if you think of investing in software to accompany a machine, it just takes time for the revenue to come through. I think in the tech sector, we've been so used to that type of company where it's kind of, we will invest today and we'll give you cash flow tomorrow. I think for some of our industrial companies in particular, we need to just change some of the narrative and say to these companies, it's good. We would like to see you make those investments to take that short-term hit in terms of the downward trajectory of profit that will result from that investment, knowing that the returns will come into the future. But you're right, you need to have that 3 to 5 year investment horizon, and that's also part of what you need to have in order to take advantage of some of these legislative changes that have made. Legislation is slow, and you're not going to see that money in 3 to 6 months.
Katrina, this was smart. It always is. Katrina Dudley there of Franklin Mutual Series. Thank you. TK, no bets. That's you told.
It's active passive. I mean, Sonali Basak with her Cliff Assis interview. I mean, all this comes down to is the active passive debate with the overlay of the economic and the fixed income talk we babble about 24/7.
In the next hour, more fixed income talk, bit of Fed speak. Jay Bryson, Chief Economist of Wells Fargo, 8:30 Eastern Time. Look out for that. Up next, we'll talk Goldman Sachs and their upcoming Investor Day.
Good.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. SpaceX and NASA has scrubbed a rocket launch shortly before liftoff early today. The mission would have sent U.S. astronauts and a Russian cosmonaut to the International Space Station. Authorities blame a ground system issue. The next launch opportunity will be Thursday. President Biden has ordered door-to-door health surveys following that train derailment in East Palestine, Ohio. Representatives from federal agencies visited about 350 families over the weekend. That train was carrying toxic chemicals. Bloomberg has learned that Hong Kong may scrap its mask mandate as soon as early next month. Indoor and outdoor mask requirements may be removed at the same time, but masks would still need to be worn at high-risk places, including hospitals. The mask mandate is Hong Kong's last pandemic restriction. HSBC is looking for a new global headquarters in London that's about half the size of its current space. Bloomberg's learned the bank wants between 400,000 and 600,000 square feet. HSBC plans to cut office space by 40% globally compared with pre-pandemic levels. Its current lease in Canary Wharf ends in 2027. And Pfizer reportedly is in early-stage talks to buy Seagen. According to the Wall Street Journal, a deal would be expected to command a premium above the company's $30 billion market value. Seagen develops drugs to treat cancer and related diseases. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Very uncertain time, an uncertain time given we're changing monetary and economic conditions very, very quickly. And that's certainly having an impact to slowing down economic activity. And so if you're running a big financial services firm, I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
Bumpy times ahead, not just for the bank, but for leadership as well. That was David Solomon of Goldman Sachs speaking with Sonali Basak back in December. We'll talk Goldman and their Investor Day, which takes place tomorrow in just a second. Your equity market looks like this Monday morning. If you are just tuning in, we have a lift on the S&P, up 0.5% on the S&P 500. Yields a little bit higher as well by a single basis point, Tom. 395.70 on a 10-year. Just a little touch of euro strength. Euro dollar 105.59, up 0.1% TK. Going into another read of Eurozone inflation later this week, and after a week of euro weakness and dollar strength.
The economics is there, and the view into the yield markets there. John, 3.96 in the 10-year, and the German out, I think it was back to 2011, and that's a high-rate regime. And that's part of what we see for all of global Wall Street. And all of global Wall Street tomorrow, I believe it is, will be completely focused on a Goldman Sachs Investors Day. Sri Natarajan is encyclopedic on the moment as well. Kid comes out of Hamilton College. He's rejected as a security analyst, I believe, at Goldman. Fine, you know, everybody get in line. A lot of people are rejected. He builds a career in, I'm going to call it bonds, leverage finance and such, ends up back over at Goldman Sachs and climbs on board. What was Mr. Solomon's first day at Goldman Sachs like? What was the real backstory that you've reported on?
Well, first day at Goldman Sachs back in 2000 was probably filled with regret because it was a few months after the bank's IPO, so he wasn't one of their pre-IPO partners. But in the last 20 years, he's clearly built an exceptional career at the firm because now he's running Goldman Sachs Group Inc., which is undoubtedly one of the foremost Wall Street powerhouses there. When you think about investment banking, when you think about trading, when you think about a bank that can communicate with governments, institutions, hedge funds, you are thinking about Goldman Sachs. Solomon's challenge is to take that and try and make it something more than that. In the last 5 years, he's had mixed results on that front.
In your wonderful article today, I'll put it out on Twitter, folks, really a great summary there. You talked to a guy named Mayo, who I've known for years, and I believe it's Mike that says, look, this is a guy that nailed it, just as you said, and he had one course where he butchered it. Have you ever butchered a course, John?
Sure, many times.
I have many times is the operative word here. How does he fix that view tomorrow?
That's the important thing. And Mike Mayo, and it's not just any banking analyst. Mike Mayo is in some ways the dean of Wall Street banking analysts. And when Mike Mayo says, look, on a scale, I can give you A+ for your legacy businesses, which let's acknowledge is still 70% of their business. That is a good grade. But then he says he's had middling results on many other fronts, including an F grade in the consumer banking operations. And the question he's asking is, you have failed a class, and what's the consequence of that? And that's important because the perception and the image you have of a Goldman Sachs is a place that does not tolerate average. So when you have a venture, when you spend so much time into saying you could build a new platform that could become the leading digital banking firm in the country, and then that gets unraveled, that puts a lot of pressure. And even after the reorganization they announced a few months ago, that has not satisfied the partners inside the firm, that has not satisfied investors and analysts. So they are still seeking answers. So the question is, are all options still on the table? Will they be forced to do another radical revamp?
Are we suggesting they're tolerating average at the top of the business?
Average rating overall, yeah. That's, if you listen to Mike Mayo, that's where it gets to. He's given me a scale from A+ all the way down to F,
so
and
where
a couple of B's and C's thrown in there.
Where does the oversight come from? Who's responsible to correct that?
At Goldman Sachs, it's interesting. Unlike perhaps most other places, some of the oversight comes from people reporting into Mr. Solomon, because even if it's a public company, it is still a partnership. And the partners still have a reasonable amount of sway. Ordinarily, you will say the board, but the board does not tend to act and show up and kick and scream when the performance is average. They are there for crises. They don't come and say, well, your stock's not great, your stock's not bad, time's up.
So Massachusetts Financial Services owns 2.04% of the stock, and they've just learned it's a partnership. Is that what I think I heard?
Well, can you tell us how much tension is there between the partnerships, the partners, and Goldman's CEO?
You can't really hide it anymore. It's pretty much spilled out in the open. There is clearly a lot of grumbling. Some would even say a semi-open revolt. And they have tried to raise questions. And to be fair, the top of the house has recognized that. David Solomon, John Walden recognized that there is some dissatisfaction in the ranks. They will point to, among other things, that these are people who are unhappy with compensation in 2022 that came off the ridiculous highs of 2021. That deal-making business is not back, and people are still sitting around twiddling their thumbs and will find for reasons where they can point their fingers and say that's not going well.
In your great article, Gorman, book ratio 1.8, Solomon 1.1, 1.2, whatever it is. I looked at operating income. Peter emailed in from Connecticut and said, Tom, look at operating income. Let's look at operating income right now. Morgan Stanley, 25 cents on the dollar, and I'm going to model the challenges of Goldman Sachs a lot less than that, 17 cents on the dollar. How do they get the operating income ratio up other than growthiness?
Here's the amazing fact here, right? If you look over a time period of 5 years, and if Goldman Sachs were to make $400 billion in revenue, let's say, Morgan Stanley were to make $350 billion, there is still a good chance that equity investors would value that more because it's much more predictable and they could model it. Whereas Goldman Sachs has perhaps made more money, but that is to their detriment. As much as 2022 was bad, in some ways the fact that they did so well in 2021 might also count against them.
Yeah, I get that. I mean, I'm thinking of Brad Hintz, iconic at Sanford Bernstein years ago. Everybody hung on his black books. If Bernstein wrote a black book on Goldman Sachs right now, can they develop that persistency of cash flow of the modern global Wall Street ship?
And we have this line in the story. When you go back to 1999, the Goldman Sachs IPO prospectus talks about the need for building stability in earnings. They talk about how asset management will play a key role. 25 years later, we're still talking about that. That idea of ballast has been around. It's about execution. And let's be clear, Goldman Sachs has been trying to do that in the last 5 years. They focused a lot of effort into their asset management business, into building this alts juggernaut, sort of a mini Blackstone. 2010, when Morgan Stanley talked about going deeper into wealth management and building scale, it's not like the equity markets readily believed them. It's not like by 2015, James Gorman had a re-rating on the Morgan Stanley stock. That took a while. It didn't happen until 2018, 19, 20. Does David Solomon have that runway is the question.
Here's what matters. Solomon had a cameo in Billions. Did Gorman? No.
Are you saying it's a personality issue? By bringing that up, that's essentially what you're saying.
You and I have witnessed this at Davos. I mean, yes, it is an interpretation or guesstimate of personality. I'm not saying that's the heart of the matter, but that's the unspoken that's out there. We're saying this with great respect for everybody at Goldman Sachs.
Well, let's stress test that view.
Mr. Solomon.
Difficult to go through the counterfactual, I know. But let's go back to the original race. Lloyd Blankfein at the top, David Solomon, Harvey Schwartz. How different would it have been if the current Carlyle CEO with Harvey Schwartz taking that role? Is it now, in the coming months, whenever that might be? How different would that have been if it was him that got the nod and not David Solomon?
It's very hard to judge that way. You would have had Harvey Schwartz, who came up through the trading ranks, and perhaps 5 years later we would have been talking about how all the traders are happy. We got to get ready for your next story.
Would Harvey have done the bank like David did the bank?
That's a tough question, Tom.
Sounds like a securities analyst.
No,
I don't think you can give a fair answer.
The reason I ask the question, Sri, is because I think we often give these CEOs too much credit when things go right, throw too much mud when things go wrong. As you've pointed out, and you've said this in the last 5 minutes, they're super tankers, they're tremendously difficult to maneuver. I'm just wondering how much different things would have been if leadership was different. But ultimately, to Tom's point, the frustration with David Solomon that comes up continuously through reporting is not just the decisions, but it's the nature of the individual who's making the decisions. And perhaps the pandemic was a great example of that, when you see all these stories that the CEO was frustrated with bumping into people who worked for Goldman in the Hamptons, when the question wasn't being asked, why was the CEO in the Hamptons? Is it about the personality or the decisions?
Fair point, but in his defense, let me point out one thing, that the seat of the Goldman Sachs CEO is one of the hardest jobs in finance. It has a lot of scrutiny, and everyone has personality quirks. It just appears larger and brighter in that seat. So did Harvey Schwartz have certain personality quirks? Maybe. Maybe we'll find out in the Carlyle CEO role. We would certainly have found out if he had become the Goldman Sachs CEO.
I would suggest people watching and listening to Bloomberg Surveillance would go with the 10-year track record that we've seen here. Solomon and Gorman don't overlay on this. Morgan Stanley, 18.5% per year. Goldman Sachs, 11.2% per year. That's a 600 beep outperformance.
I think you've drawn a line under it. That was good enough.
Was that okay?
That was brilliant.
I did okay.
Sri, thank you. Looking forward to your coverage tomorrow.
Yeah,
Sri Natarajan there, Bloomberg. On the latest from Goldman, their Investor Day begins tomorrow. Equity futures right now on the S&P still elevated just off session highs, up 0.4%. Coming up shortly, Gene Tanuzzo of Columbia Threadneedle.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we could do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
potential.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
As governments, we have a responsibility to create the incentives and the space for you to flourish, a receptive environment for change, and the accountability that comes with guardianship. In many nations, the foundation for this approach has been laid for us long ago if we choose to listen. Where I come from, Aotearoa, New Zealand, a beautiful place you must visit, our Indigenous people hold a worldview that every single living and non-living thing.
Monday, an eventful Monday as we stagger into March. Futures up 17. The VIX still sustained 21.66. But John, you and I, equities, no. Commodities, no. Even FX, no. Bonds.
Without a doubt, that's the driving force of this market, Tom. It was on Friday as well. It is this morning, too. On Friday, a new closing high for a two-year yield, the highest since 2007. Tom, bottom line, we have absolutely no idea what sufficient restrictive actually is at the Federal Reserve, and we've been changing that view continuously over the last year.
Stay with Bloomberg through the day, because every 2 hours, I would say, there's some form of record. Earlier we saw, just for a moment, a print of the difference in yield between the 2-year and the 10-year, a stunning 0.90 percentage points, moved the decimal over to 90 basis points. And John, the German 10-year, that limits Christine Lagarde's degrees of freedom.
Highest since 2011, the assumption being the ECB is going to be hiking as well. Look out for their next meeting as well. 12 months ago, the Federal Reserve was still doing QE. Rates were still at 0. They went into the March meeting, Tom. They came out with a new dot plot. Do you know what the dot was for 2023 in that March meeting? 2.8%. 2.8%.
Where are we get dots March 22,
we'll get dots.
Right? What do they look like? What is the dispersion that we see, the center tendency? No one knows. Just
amazing that it's going to be close to 550, maybe, basically. What we've seen so far, that's what the market's pricing. And the divide, and we've touched on this a few times, between the Fed and the market. Remember that? We've got to close the gap. How do we close the gap? Well, the market's above the Fed now, and the Fed's going to be lifting that dot, no doubt.
This is
if the data
now,
sticks in the way it's been coming in.
We're going to give you a complete bond data check here in a moment. But, John, just one more observation here. The economic data matters. Jobs delayed. Everybody steeled for March 3, March 4, no. I believe it's March 10, Ancient Jobs Day, but ISM is there to get us started.
2 Fridays away. ISM will give you a sneak peek of the February data. I think that's important. Will February confirm January? But ultimately, that's going to come down to payrolls. It'll come down to the CPI report as well. Do you want a sneak peek of the markets right now?
Please, bonds.
Equity futures, positive 0.5%.
Bonds.
TK wants bonds. I'll give you bonds. Yields on a 10-year high by 3 basis points, just short of 4%, Tom. 3.97 on a 10-year yield this morning.
Very good. What we're going to do now is gather, I would say, in the bond market, and that means a changing attitude, and someone always good at that is Gene Tenuzo, Global Head of Fixed Income at Columbia Threadneedle. Gene, how have you changed your view with the new leg up, and do you have to steel yourself for price down through what I'm going to call, as a general statement, the October lows in price?
Yeah, good morning, Tom. Look, I think when we look back to where we've been since the October lows in price or highs in yield, we've had 2 months, December and November of 2022, where growth and inflation both look softer, and definitely 1 month in January where both of those data prints looked much, much hotter. And the question is, when you put those things together, what does the aggregate tell you? What it tells us is that we are moving back both in growth and inflation to what we would refer to as the old normal, that pre-COVID growth rate closer to what we saw in 2015 to 2019. And we think January, while it was certainly a good month, certainly a warmer and stronger month, will prove to be a bit of an anomaly as we go forward.
Summing it all together, then, you have to come up with a conviction on bonds. John, how many convictions have we heard this morning?
I think we've changed our conviction at least 5 times.
5 times, I would say. Gene, what is the Columbia Threadneedle conviction of duration?
Well, right now we are constructive on duration. I think the simplest variable to look at is the real 10-year yield at near 150 basis points positive. That is restrictive territory by most measures, and that should help restrain growth. And we're starting to see that just as inflation pressures start to abate. Now we can look at the inflation report from January and say, wait a minute, that was higher than we expected, but the largest contributor to that was still housing, and there's ample data to suggest that rent and owner's equivalent rent will be coming down in the next few months. So that gives us comfort to hold more duration, particularly farther out the curve. I think it's that 2-year point that's going to continue to be volatile as we get into that next Fed meeting, and the Fed wants to send a message that rates are going to stay elevated for an extended period, maybe as much as a year or a little bit more.
But ultimately, Gene, you think we go back to the pre-pandemic years of low inflation, low rates of growth? And Gene, I guess my question to you would be, January was a head fake. That seems to be your take right now. How many months of January would you need to see to change your mind?
Well, look, we added 500,000 jobs in the month of January. That's a fantastic turnout for the U.S. labor market, but it's also mathematically unsustainable given where we are from the starting point of the unemployment rate. There simply aren't enough human beings in the economy to continue to repopulate the labor pool that way. So I would expect that we would see that to slow. If we did see that over another month or two, absolutely. I think we have to reassess the thesis, and that's something we need to be very mindful of. But this has been a resilient economy, and one where I really think rather than looking for the big day where the entire economy goes into recession, we need to be looking at pockets of the economy and specific industries that are really seeing that weakness and seek to navigate those rather than wait for the big bang.
Where are you seeing that at the moment, Gene?
So there are really 3 areas, John, where we see that. We see it in housing and home builders. That makes sense a lot as it relates to where interest rates are, with the 30-year conforming rate back over 7% this morning. We see that in manufacturing. That certainly was weak into the fourth quarter and the beginning of this year, maybe starting to get a little bit less bad, but still a weak spot for the economy. And then the third piece, which is a little bit more broad, is really looking at that lower income, lower FICO consumer, where delinquencies are rising, and we see that in auto loans and consumer loans as well. So those areas are places we need to navigate as we invest. But even with those pockets of weakness, we may not see the NBER classify the entire economy in a recession.
Gene, the rationalization among institutional Wall Street after a brutal last year, I don't need to tell you about total return, is at this time you can be more flexible, almost more fungible in your belief, because you're going to make a coupon along the way that you couldn't make 18 months ago. Is a coupon going to rescue fixed income Wall Street this year?
I think it's critical. We should think of 2022 as the year that fixed income got its last name back. And income matters, and it is the cushion that you have to soften the blow of volatility. And when we look at whether it's 10-year treasuries near 4%, or you start looking at investment-grade assets like non-agency mortgages with yields over 6%, or even short-duration double B, single B high yield in the 8% range, these are equity-like returns with a fraction of the volatility. Even if you have the Fed arm wrestling over another quarter-point hike or 2 or 3, that volatility can be absorbed by a much more attractive coupon here.
Gene, it's amazing listening to this conversation and comparing it to the conversation we had in the studio 60 minutes ago with a different guest, because, Tom, it was totally the opposite about the bond market, about the new regime we're in. Gene's talking about going back to the old years, and Alberto's talking about a new reality.
I think that's the arch call here. That, you know, I hate to use the word, I really detest the word with a passion. I circle it every time I read it. Paradigm. Do we go to some new paradigm, or do we return to what we knew? And that's truly an arch 36-month, 60-month call.
Gene, one differentiating factor that Alberto Gallo brought up was fiscal policy. What's your call on fiscal policy and what it means for whether it complements this Fed's effort or complicates it?
Well, through the course of the last 12 months, it's really been an additional restraining factor, an additional tightening factor on the economy. Throughout the course of this year, that will start to fade, and it will be, I think, more neutral through most of 2023. And it's really going to depend on new policies from here if that's really going to change the regime. But I wouldn't really call fiscal policy at this stage a game changer. It's really the fact that fiscal policy was a stimulant 2 years ago, and that's gone away.
Gene, this was great, as always, buddy. Thank you. Gene Tenuso there of Columbia Threadneedle on with a very, very different view on this bond market, TK, and ultimately the framework for thinking about the regime we're in.
And what was critical here, folks, is 12 months from now, even 9 months from now, when, Fair, you're publishing your year ahead.
My outlook comes out
your
in March.
70-day outlook comes out.
Of course.
You're in the final rewrite now, right?
That's right, yeah.
Trying to cut it down from 56 pages.
Just waiting for the March 10th
34.
payrolls report, just to get, just to get a little bit more
your interns on that.
backward-looking information for the forward look.
Can we talk about valuations here? I'm just dazzled by this. There's like very few Formula One cars, right? There's like 10 teams, and there's only like 20 drivers. I did not know that. And the fee to get 11th team is up to 600 million or higher.
Wow.
It was 200 million a cup of coffee ago, a good Italian cup of coffee.
That's to get in.
Just to get in. Mario Andretti's son, I think, is looking at this for GM and Cadillac. And then I look what a baseball team costs. And the head of the baseball team, MLB, was quoted in the vicinity of 2.2 billion would be the cost of a new baseball team. Where does this money come from? I mean, I'm serious.
It costs so much money to run those F1 teams, though.
How much do those cars cost?
A fortune.
Like
I couldn't
millions,
give you a precise
right?
price, but a fortune. They've tried to put new budget caps into place to make it more affordable for new entrants and to try and make it more competitive. Because otherwise you'd have the likes of Ferrari, Red Bull, Mercedes that just spend as much as they possibly could on winning, which is what used to happen. You could have the maximum amount. You could have as much testing as you wanted. You could have many pieces, parts, money, all of the above. And they've really tried to constrain some of that in a bigger way.
Do they get relegated?
There's no relegation.
There's no, the team
but some teams drop out of the sport. That's happened many times.
I just can't get a handle on the money being spent. I just don't understand it.
Well, wait, have a Google of the salaries for the drivers. Have a Google of that.
Yeah,
have a look.
You'd be great at that. I could see you doing
driving Formula One cars.
They start out when they're like 7 years old, right?
Just different life.
They do the kart thing.
In karting. Christian Horner, who runs Red Bull, great guy. He was driver as well at one point.
We should get him on.
And we should get him on. And he talks about this time where he figured out that he just wasn't going to make it. And he was coming through the first corner of, I forget what track, and another driver came round, and he said there was this moment where I would lift off. Just instinctively, my brain could not connect with my foot to keep my foot down. Yeah. And I watched someone go past me flat out. And he said that was when I knew I'm just not cut out for it. They think differently to us. Those guys just
Verstappen, they think.
Yeah, they think Lewis Hamilton, those guys.
They think like Brahmo.
Cream of the crop. They think
like they're as tough as Brahmo.
Brahmo. Yeah, that's right. That's well put. Well said.
Thank you. Well said.
Libby Cantrell of PIMCO up next.
She's well said.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. British Prime Minister Rishi Sunak and EC President Ursula von der Leyen meet today. Now, it's a signal that the two sides are ready to settle their differences over Northern Ireland. Finalizing the region's post-Brexit trading arrangements has been an issue since the withdrawal agreement was reached in 2019. Saudi Arabia has signed agreements worth $400 million with Ukraine. The kingdom's foreign minister made a surprise visit to Kyiv and met with President Volodymyr Zelensky. Last week, Saudi Arabia voted for a United Nations resolution calling for Russia to pull its troops out of Ukraine. A U.S. government investigation reportedly has found that a laboratory leak in China most likely caused the COVID pandemic. According to the Wall Street Journal, a classified report on the Energy Department probe has been provided to the White House and key members of Congress. The Journal says the department made its conclusion with, quote, low confidence. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I do think China is a major threat against the United States. Look, they're encouraging this war by working with Russia. China needs to know there will be consequences. We've isolated Russia economically. We can do the same thing in regards to sanctions against China. China needs to understand that they need to be on the right side of history here.
Going to hear a lot of that, Tom. That was the Senator Ben Cardin of Maryland of Fox. Why do I always mess that up? Maryland.
I like the way you
Maryland.
did it. No, I think
Maryland.
it's charming. Say Maryland. That's what you guys say, and it's beautiful.
Maryland.
It's like I say Warwick.
Maryland.
It's the same thing.
$12 to $15 million for an F1 car, just so you know.
And they break the front end off like every third race, and they just bring out the new front end, put that thing right in.
Yeah, and that costs serious money too. So
yeah,
there you go. Gives you an idea of how expensive that sport is.
That's good.
So we talk China. We'll do that in a moment. Let me get you some price action briefly. Equity futures. The people of Maryland love me. Up 0.5% on the S&P 500, like the people of Warwick love you. Yields higher by a couple of basis points, I'm sure, yeah. 10-year, 397.
Joining us now, and I want to do a really more focused discussion here on the distance across what in my ute was the Formosa Strait. Trust me, there's been people from Taiwan over the years, led by Scarlet Fu, that have grabbed me by the bow tie and said, shut up, this is the way it is. Libby Cantrell is expert at looking at the way it is in Washington. She's head of public policy at PIMCO. Libby, I want to get away from the zeitgeist baloney and know that Pelosi made a trip to Taiwan, the former speaker, but other politicians have followed on. What is our relationship with Taiwan right now?
Yeah, well, good morning, Tom. Starting out with the light questions here on a Monday morning. Yeah, I mean, I think the sort of the purpose of certainly former Speaker Pelosi and then the delegation that just went actually last week is to, in many ways, I think, send a pretty strong signal to China that the United States will continue to support Taiwan. Now, of course, our policy in terms of strategic ambiguity has not changed in terms of kind of the one China policy, but we are, I think, very much sort of sending a signal that should that change, should China in particular do anything to disrupt that very kind of fragile, tenuous relationship, that the United States will sort of back up Taiwan. And of course, there's some preemptive measures that the United States is taking in terms of providing arms and what have you to make Taiwan sort of a porcupine, so to speak, in terms of being able to defend itself. But again, I think these visits in themselves are very symbolic in terms of sending a signal to China that the United States is monitoring this relationship very closely.
Perfectly said. They're symbolic, except all of a sudden the Secretary of Defense is talking to Mr. Marcos, the younger of the Philippines, about, I believe, 4 bases over there. And there's relationships with Japan. Do you see in the Republican-Democrat bipartisan debate on China a new Pacific Rim policy of Capitol Hill and Washington?
I think politically it's quite difficult to do anything formal. Of course, as you know, Tom, the Trans-Pacific Partnership was in some ways trying to get to that, trying to isolate China, at least economically from a trade perspective. But I do think that sort of a de facto policy is emerging, both from the administration's perspective and also a Capitol Hill perspective, to really try to alienate China or try to isolate China geographically.
John, this is chilling in that it's a discussion from my youth. It's like a warp back to, I'm guessing off the top of my head, 72.
Well, there was a hope we'd left some of this behind, Tom, but it's back on the agenda in so many different ways.
Yes, you're very well said today.
Thank you. You're well said too. You're doing great.
Appreciate it. Libby and I aren't, but you are well said.
Libby, I want to go to a publication in Germany that came out with a report last week that a Chinese manufacturer was in discussions with Russia to sell them drones. Libby, the United States and the administration have been very transparent about the intelligence they've been receiving. They say it's a risk. We want to understand what the consequences might be. Libby, what do you have in mind if that did so happen?
Yeah, and I mean, I think, John, you're exactly right that the administration is really trying to be as sort of transparent and forthcoming here in terms of their warnings to China. Of course, it doesn't seem like we have intelligence that they are providing military or lethal aid to Russia, but a pretty stark warning from Blinken, from Secretary of State Blinken and other folks, that if they should, that there will be consequences. In terms of those consequences, John, there are secondary sanctions. That has been something sort of on the tip of the tongue of many members of Congress, really since the Russian invasion of Ukraine, and sort of this view that China has been, kind of complicit in all of this. So I think secondary sanctions would absolutely be on the table. And then more export controls. Of course, we saw the administration move forward with pretty punitive export controls, pretty focused, however, on advanced semiconductor chips, but that could also expand to other sectors should there be intelligence that China is providing lethal aid to Russia. Of course, there isn't that yet. We should just clarify. But if that should come to sort of public light, I think that Congress, in particular, will move forward pretty quickly on this.
Libby, can we talk about a couple of cross currents at the moment then? So the administration seems to be on the same page as Congress, both Republicans and Democrats, when it comes to containing, say, the competitiveness, the economic threat that maybe the Chinese Communist poses. At the same time, we seem to have this fraying when it comes to supporting Ukraine and the military effort in Ukraine within Washington, D.C. If we put all of that together, and let's say we face the very real probability of ending up in a proxy war with China in Ukraine, what would support look like in Congress to continue funding the military effort of Ukraine against Russia?
Yeah, I mean, I think just to be clear, I don't think the administration wants this to be a proxy war at all. And I would say, John, that although there have, of course, been a lot of media reports about the softening support, especially among Republicans in terms of supporting Ukraine, I think that's a bit overstated. I would contend that the center has very much held in terms of the support for Ukraine. You had Minority Leader Mitch McConnell very emphatically saying that the support for Ukraine will continue. That may come with more conditions, a little bit more oversight from this Republican House in particular. But I think we should not, the point here is that there is a lot of congressional support for Ukraine, regardless of what happens with China. And then, of course, if it does devolve into a proxy war, which, again, I don't think anybody wants, particularly in the administration, I think you'll continue to see even more support.
Libby, quick question, Sharp Sagui, if I may. In the headlines of the papers today is this never-ending legal debate on student loans. Has that engaged Washington, or is that a story that's off the radar?
No, I think it's very much engaged Washington. It's also a really important issue for a lot of Democratic voters, in particular, a lot of young voters more broadly. So I think a lot of folks are going to be watching this. I think our view has been that the legal justification for the student loan cancellation was a bit tenuous. Even former Speaker Pelosi had said that Congress needed to do it, and Joe Biden had said that at one point as well, that is actually in Congress's remit, not the administration. So, I think we would be surprised if the court sided with the administration. But of course, a court decision probably is not going to come until next year, or sort of later this year. Excuse me. So we'll have to see. But yes, I think that lots of people will be paying attention to those arguments this week in front of the Supreme Court.
Libby, this was nice. It's been too long. You notice how Libby's been avoiding us? Have you noticed that?
Hardly. Come on, John. Never. Never, guys.
We've got to make this happen more.
I'd rather you be talking about the Denver Broncos though than these,
Well, we've been ordered. We can't do that. It's so depressing that we can't.
Hey, Livy, thank you. Livy Cantor there of PIMCO. One of the best. It's been too long. Got this email just as that interview was ongoing. Here we go. Given that it was named after Queen Mary, you get a pass on Maryland. Just so we clean that up. Did you know that it was named after Queen Mary?
Not Queen Mary of like 1905. The Queen Elizabeth's
King Charles's wife.
Grandmother. No, this is Queen Mary from back a few years.
Going back.
Like maybe pre-Elizabeth, I'm thinking. You know, like 1550.
Whenever Maryland was named.
Maryland.
Yeah.
It sounds great. It's like, you know, we've had this argument at Bloomberg for years, folks, on pronunciation, and my answer is what's ever comfortable for the speaker.
You know what? I agree.
I agree.
I agree. We shouldn't judge.
I was lectured that Mexico should be Mexico, and
who told you that?
I was a senior officer, and you know, I said you have to say Paris, and I said I'm not going to say Paris. Nobody will know what I'm talking about.
If we get into cities,
Paris.
we'll be here a long time. Yeah.
I mean, I was watching Emily in Paris, and you know, she says Paris.
You're going to be okay on your own? I'm going to go.
You're leaving?
Yeah.
This is not in my agreement. I mean,
Seema Shah coming up, Principal Asset Management. Jack Caffrey at JP Morgan, looking forward to that. Sam Linton-Brown of BNP Paribas last summer said get long Eurozone banks. I was like, has this guy been drinking with TK? What's he talking about? Get long European banks. And European banks.
He's very good.
Have absolutely
very
ripped. He's a very smart guy.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names at the Fed are on Bloomberg.
Inflation is normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Bloomberg Surveillance, we say good morning to you on a Monday. Interesting economics forward. We go to March 10 to get to the jobs report. It's the oldest, lengthiest, forever into the month, deepest report Michael McKee has ever seen. Along the way, there's important economic data. And right now, we speak to the durable one about durable goods, pending home sales later. durable goods, Mike, they matter, don't they?
They do matter. We've been watching business spending. It was a little weak in the fourth quarter, but it comes in down even more for the first month of the year. Durable goods orders down 4.5%. Ex-transportation, though, they're up 0.7%. Remember, Boeing had a big month in December, and so there's some payback statistically for that, which probably explains the ex-transportation number being positive. The good news, capital goods orders, ex-defense and ex-aircraft is up 0.8. That follows a 0.1 decline in December. So businesses did pick up spending during the month, it looks like. Shipments were up 1.1%, which will add a little bit to GDP. So the durable goods orders begin the month on a reasonably good note. I'll have to get the breakdown and see exactly what was spent, but I'm assuming that that headline decline is Boeing.
Mike, I look at this, and I've got up in front of me, folks, 6-7 years of durable goods data and many great economists. I know Hatzius lectured me once on it at Goldman Sachs. They're always looking at a 3-month moving average. Any of the moving averages I look off the COVID wackiness show durable goods sustaining at a higher level than they were 2017, 2018. Is that what we observe in the American economy, or is it just Boeing?
Well, you have to take the Boeing numbers out of the headline. They just one airplane.
I did that with this series.
Your airplane, the surveillance Gulfstream, just costs so much money that it distorts the figures. But also cars have been a distorting factor in the sense that we've had strong car sales, then they dropped off, and now they come back. So on a percentage basis, you're getting some rebounds effect there. And so at this point, it looks like business spending has been hanging in. We haven't seen as much in terms of durable goods purchases by consumers until last month, and we did see an increase there. It's going to be interesting on Wednesday to see the ISM manufacturing numbers and see how much is going into inventories and how much is going out the door.
Very quickly here, housing data. I want to come back to you here in a moment, but after Dr. Bryson, but housing data. I mean, how key is the data today, and critically, Case Shiller tomorrow?
Well, we want to see what's happening with prices. We know that prices have started to come down. New home sales and existing home sales prices did drop a bit. The question is, when does it start making it into the CPI, of course, and that takes about a year because rents people signed a year ago are still being counted in the figures. So we should, the feeling is we should start to see it show up in the data the Fed cares about when we get to maybe May or June.
A durable report from Michael McKeon. We've got it with a market lift as well. Futures up 24. NASDAQ up 0.7%, 12,085 on the NASDAQ 100. It is a joy to bring in Jay Bryson. He is chief economist at Wells Fargo with a truly international bent. Jay, let me start with a basic idea. Is Jerome Powell the banker to the world? Is he the central banker to the world now in honor of Bill Rhodes?
Yeah, I mean, I think in general, I think the chairman of the Federal Reserve over the number of years has been the most important banker. Now, is he banker to the world? Is he here to bail out the rest of the world? No, not necessarily, right? They only have really two objectives. That's inflation in the United States and the unemployment rate. But clearly, the Federal Reserve is the most important central bank in the world.
My recollection is you memorized the Taylor rule watching March Madness down at Chapel Hill many, many years ago. I missed this today. One of our previous guests, Jay, had it out how distorted the Taylor rule is once again. Torsten Slok suggesting up near a 9, even 10% Taylor rule. What's the Powell rule right now? What's the equation Jerome Powell's using if the Taylor rule is busted?
Well, so you think about the Taylor rule. I mean, there's two variables in there. Well, one would be inflation, and one would be the unemployment rate or the gap there, the output gap. And I think there, the overwhelming weight is on inflation right now.
Yeah.
And it's the Fed right now is much more reactionary than forward-looking. I mean, if you think back to Jackson Hole a few years ago, I mean, they essentially threw out the forward-looking sort of stuff, R-starred and et cetera, et cetera. It's all about where's the economy right now, and they're kind of really trying to feel their way in. But again, it's all about inflation right now. Where all the weight is.
I mean, so much of this is our complete focus on the Fed. Are we going to be doing this all year? I mean, the Fed Derby, the Dots Derby, the Michael McKee Derby. Jay Bryson, are we going to be doing this for the rest of the year?
You know, I think so, Tom. I think it's going to be a high weight on what the Fed is doing. Now, if we get in, a few months from now, and it looks like the economy is really starting to slip, I think what really becomes important now are initial jobless claims and other labor market sort of variables. But for the foreseeable future, I think it's really all about the Fed.
Can we, I'm looking at this almost as domestic final sales, can we, quote unquote, slip? Or can we just say it's the housing market and other financial distortions slipping, and the rest of it does pretty well, like durable goods just showed? How does that mix play out?
Yeah, so, if you think about the consumer right now, the consumer is very, very strong financially. And so you could have a recession this year in, say, manufacturing, strong dollar, weaker growth in the rest of the world. You could have weakness in the housing market. I mean, that's what we've seen for the last, almost year now. But consumer spending could continue to hold in there. And given the fact that consumer spending is 70% of the economy, you could have a few sectors in the economy in kind of recession, and the overall economy wouldn't necessarily need to tip into recession.
I mean, that's right where I wanted to go, is you got an NBER recession here, and I note yields coming in abruptly here. 2-year yield into 4.78%, down 3 basis points. 10-year yield migrates away down 2 basis points, with a little bit, just a little bit of curve inversion. I don't want to oversell that. Futures up 30. Jay, I look at the stew, as Lisa would say, that we're in, and to me, I want to, just as you said, partition it. If we slow down, we don't all slow down, do we?
No, that's right. I mean, the economy, there's lots of different sectors in the economy. You think back, Tom, about, back to 2015, 2016. China was having some real problems. The manufacturing sector back then was in a recession. The overall U.S. economy was not in a recession. So you can have different sectors going down and not the whole ship going down. Now, if some of those sectors go down a lot, like manufacturing and housing, and then you start to get job losses in there, then it does start to bleed into other sorts of sectors in the economy. So it's a really tricky situation that the Fed finds itself in right now.
Jay Bryson, to the global footprint, which you commanded for years at Wells Fargo, how urgent is it for IMF right now? We've got the Nigerian elections and that, but how of a moment is it right now for the International Monetary Fund?
Well, if you look around the world right now, most of the world is slowing down right now. If you look at Europe, now it's not as bad as what it was, say, 6 months ago when energy prices were through the roof over there. Fortunately, when you look around the world, there are not signs of big debt bubbles like we had, say, 20 years ago in Asia, places like that, right? So obviously, the IMF is, obviously a very, very important institution around the world, but my sense is the overall global economy right now is okay. But, it's obviously the fraught geopolitical situation, potential for lots of different sorts of shocks, and so it's good to have that backstop of the IMF there if, in fact, it's needed.
Jay Bryson, thank you so much for joining us today with Wells Fargo, their chief economist here. I really can't say enough about what their team has done for us here in the ambiguities of the moment. What we have is a moment of equity markets lifting off some of the very challenging days we've had. Futures up 30, Dow futures up 225. NASDAQ not out of stick, but almost there, 0.9%. Even the VIX cooperates in 21.40. In the yield space, a yield reversal, higher yields, really threatening out to record high yields this morning, and we come back down 4.78%, 2-year 3.92% on the 10-year yield. Right now, Michael McKee, to give us a clinic here on how removed the Fed is. I was thunderstruck by Torsten Slok's note today on the Taylor roll. As you know, we have a fabulous function on the Bloomberg. I went to it, TAYL, And I really did not understand, Mike, how removed the where we should be is from where the Fed is right now. They can't catch up to the where we should be, can they?
Well, I know you've been discussing this morning the utility of the Taylor rule these days, and there is a lot of discussion about that. It tends to backfit better than it does to predict, and John Taylor's told me he didn't invent it to make predictions.
He didn't invent it to nowcast.
to nowcast. Part of the problem is to get ultra wonky, you need to know what R star is, or you need to have a number you're plugging in for the output gap. And that is a really hard thing for people to come up with these days. I was talking with a Fed official yesterday, or I mean Friday rather, who said that the calculations were so thrown off by the pandemic that it's been hard to come up with even a number that you don't even trust, but just a number.
In the discussion, and Mike's on the phone all day, folks. I know you think he comes off and looks at Denver Bronco football, looking forward, but he's working nonstop on this. To the point that John Farrell mentioned earlier, there's a group of people who say we're going to get back to some form of the paradigm pre-COVID, and there's another group saying we're moving on to something different. Where are the people you're talking to on that? Is it two separate camps, or do they really feel we're just going to get back to some kind of economy we once knew long ago and far away?
I think there's two separate camps, but without a huge confidence level in either of their predictions. We don't know exactly how the end of inflation is going to come about, whether demand craters because companies are raising prices or companies feel like they've raised prices enough to cover their expenses. And so it's going to depend on where the Fed has to set interest rates in the next few years. We've got to get inflation back down, and then once that happens, what kind of world do we go into? That's the part that everybody's trying to figure out.
Can I suggest that when they do the dots, March 22nd, they do the dots of everybody in the press conference?
Including us.
That would be interesting.
Thank you. They told me in economics school, don't make predictions.
Michael McKee, thank you so much. It'll be a busy week here. Mike McKee focused on housing data at 10 o'clock and then on to very important ISM data. I am thrilled to tell you, coming up on radio and television, Rob Arnott.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. SpaceX and NASA scrubbed a rocket launch shortly before liftoff early today. The mission would have sent U.S. astronauts and a Russian cosmonaut to the International Space Station. Authorities blame a ground system issue. The next launch opportunity will be Thursday. President Biden has ordered door-to-door health surveys following that train derailment in East Palestine, Ohio. Representatives from federal agencies visited about 350 families over the weekend. The train was carrying toxic chemicals. Off the coast of Italy, a wood boat filled with migrants broke apart after smashing into rocky reefs. At least 60 people died and dozens more are missing. Authorities say the boat had more than 200 passengers when it left from Turkey. TD Bank has agreed to pay $1.2 billion to settle litigation involving the Stanford Financial Group. A lawsuit had claimed that a group of banks enabled the $7 billion Ponzi scheme of financier Alan Stanford. Stanford International Bank sold billions of dollars in fraudulent high-interest certificates of deposit. And Pfizer reportedly is in early-stage talks to buy Seagen. According to the Wall Street Journal, a deal would be expected to command a premium above the company's $30 billion market value. Seagen develops drugs to treat cancer and related diseases. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Move quickly now, reestablish credibility now. Sometimes I use the phrase, more game theory, less econometrics. What you really want is the establishment of the credibility of the 2% inflation target. There's a certain amount of demonstration to markets if you move quickly.
A gentleman from Indiana University, James Bullard of St. Louis, and he says, get on the x-axis and move quicker. That's been one of his themes here in these most unusual times. Before I bring in my guest here, you know, I look at what the guy from Indiana did, and I mean, frankly, you know, if you're at Villanova and it's your birthday and you're getting an MBA, you need to lean forward when Rob Arnott speaks. We send birthday greetings out to Simon this morning. Thank you for watching, all of you with birthdays near, far, and clear as well. Thank you for listening and watching Bloomberg Surveillance here in these unusual times. Rob Arnott is absolutely unique. Out of the University of California at Finkidlin, also called Santa Barbara, he did one of the hardest things you can do in research. He did brilliant research and then kept doing it. That is an extremely rare commodity in the racket. To say he's chairman of research affiliates barely describes his contribution to the Chartered Financial Analyst Program and to thinking out there about what to do and what not to do. Rob Arnott, thank you so much. And you know, someone's going to say you're bearish in that. Well, forget about that. What's the biggest mistake right now in a type 2 construct? What's the thing desperately not to do right now?
I think the most serious mistakes investors make are performance chasing. Whatever has done well, buy more. Whatever has faltered, shun it. And secondly, blinders, focusing strictly on domestic opportunities. I'm not bearish when things are cheap. Stocks outside the U.S. are reasonably cheap. Value stocks outside the U.S. are very cheap. And we find all sorts of narratives relating to China, relating to Ukraine, for not investing outside the U.S. But the U.S. is priced at more than twice the valuation multiples of non-U.S. stocks. And so to avoid those two mistakes, it's awfully useful to think in terms of forward returns, not past returns. And forward returns are simply a function of what's the yield, what's the historical growth in income,
right.
And if there's any valuation mean reversion towards historic norms, is that going to help you or hurt you?
Do you suggest that on a national basis, U.S. basis, or even international basis, that we're going to have a regime shift in what our interest rate will be that will allow for the fiction of a better nominal GDP, a better animal spirit out there, but in the long run won't pay off? Does Rob Arnott have to shift up from an anchored 2% to some kind of new interest rate regime?
I think we are in a transition from a failed experiment with near zero and negative interest rates. That effort to stimulate an already growing economy was beyond foolish. And I think we're seeing the beginnings of a regime shift back to a point where interest rates matter. Think of interest rates as a speed bump. If you have a speed bump on a street that's too high, it stops the traffic. If you have a speed bump that's non-existent, you're going to get the occasional reckless driver driving way too fast. And the same thing applies with interest rates. When interest rates are too high, the economy is shuttered. Interest rates now are back to some semblance of normal. People talk about Powell channeling his inner Volcker. Pardon me, Volcker took the short rate to 500 basis points above the preceding peak in inflation. Today, that would mean making the Fed funds rate 14%. He's not channeling an inner Volcker. He's dabbling with increasing rates in a fashion that hopefully won't do too much damage. And it's all based on a very naive neo-Keynesian view that you have to wreck the economy in order to rein in inflation.
Robert Knott, help me with the idea of my theme for 2023, which is if we get a normal rate regime, something many of our listeners and viewers have never experienced, let's say we get back to a regime of 16, 17, even 20 years ago, that we will see what I call the great zombie roll-up, and that there's all sorts of companies out there, domestic and international, that just aren't going to make it. How can you profit from that?
Well, you can profit from that by investing broadly diversified into markets that are cheap and will cushion the damage of those. You can avoid that damage by looking at quality metrics and not investing in companies that are highly likely to go bust. You can measure interest rate sensitivity for companies, and companies that have large debt, be very wary. Don't own them unless they're really cheap. And there's a lot of companies in the meme stock community that have huge debt. And as that debt gets repriced, they're likely to struggle. So the notion that high interest rates are going to hurt the value stocks is actually way too simplistic.
I look at one of the great quotes last year, something I think that you will appreciate. Nassim Taleb, always controversial, saying, well, the physics is back, the gravity's back in the equations. And you've certainly alluded to that. Rob, what I notice also is we've become addicted in our modern trading to bringing in our hold period of average investments from years into months, if dare I say, not even days as well. If we get the Taleb gravity, if we get the world you talk about, obviously I agree with you, are we going to learn that we have to have a longer holding period for our investments?
I think holding period should be a function of where your personal skill set is. If your skill is in short-term trading, I would never advocate that Ken Griffin take up the idea of life-cycle investing. He's doing the rest of us a huge favor by trying to scalp a fraction of a penny off of every trade you make. It gives you great liquidity. And so focus on what you're good at. I'm focused on long-term. I'm a long-term investor. I want short-term investors to be there to provide the liquidity. And folks who are not good at short-term, but playing the short-term game, they're also providing liquidity, but they're likely to get badly hurt, and they often do.
Let me finish up, Rob, with the arch question. All my radar's up on this is I've got the usual active managers trotting out telling me this is the time for active to outperform, and many of them ascribe to your international view. Rob Arnott, an update on active versus passive, please.
I think the whole active versus passive thing is a complete distraction. Active managers, the passive managers own the market. that means that if you take them out of the equation, what you're left with is that same portfolio. That's what the active managers divvy up. So an active manager can win, but generally only if another active manager is losing. So it's a silly game to say this is a great environment for active investors or a great environment for passive. The before fee performance of actively managed mutual funds is nearly identical to that of passive. And it always has been, and it always will be. So the key question is, can you choose active managers who are likely to have an edge and whose success will be funded by other active managers whose bets don't work? Look for that in your investing.
Rob, we got to leave it there. Rob Arnott, thank you so much. With Research Affiliates, and I really can't say the uniqueness of his research energy, no one has done more in securities research over a longer time than Rob Arnott. Check out so much of his work with the CFA program in Charlottesville, Virginia. Futures advance, they advance nicely. Michael McKee sending me a missile. He's saying, look, this has to do with tech spending and spending in defense in America on the war in Ukraine and also on the resupply of our defense abilities. And you see a shift here with futures up 35, NASDAQ now up 1.2%, a nice equity lift. Yields reverse. Pharaoh's been medicated for the next hour with the yield reversal here. 2-year in 4 basis points, 10-year in 4 basis points as well. What an eventful Monday. One of the most interesting guys, if not the most interesting in Washington, John Kirby with David Weston, Balance of Power, 12 noon. Good morning.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
coming off the back of the longest weekly losing streak of the year so far, and we're looking for a bounce here. Live from New York City this morning. Good morning, good morning. Equities up by 0.9% and yields lower. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, coming up, equities bounce following the worst week of 2023. The White House thinks China is target south in knots, and Twitter delivers a fresh round of job cuts. We begin with the big issue, the longest losing streak of the year.
The equity market is coming to terms with the fact that the job is not done for the Fed.
The economy does look hot.
A bit too hot to ignore.
We still have a high inflation environment.
It is still elevated. It is still pretty sticky.
Inflation remaining stubbornly higher than what the Fed wants.
It's going to be harder for them to stop raising rates.
Got a lot of big hurdles to clear.
I wouldn't be participating in stocks right now.
We are underweight stocks.
I would not rule out a return back to the lows.
We are due for a recession.
I call it the bearish truck, and it's coming.
Rough roads are ahead.
We're landed. The question is, do we hit the wall at the end of this runway?
Joining us now to discuss is JP Morgan's Jack Caffrey, Seema Shah of Principal Asset Management. Seema, let's begin with you, and thank you both for being with us. Seema, I remember the start of the year, we were meant to shift our focus away from inflation, which was too high, to growth, which was going to be too weak. It's not. What happened?
Well, I think we all got a bit of a head fake in December, made everyone think that actually, we were kind of near the end. But actually, it looks like Fed is still the main conversation here. If anything, some of the data that we've been seeing, which has suggested that the US economy is actually a lot stronger than certainly many had expected, that's just telling us that there is more work for the Fed to do. So it's not just about the growth picture, it really always comes back to the Fed. So we are not past that just yet.
You're not alone. Jack, I wanted to share this quote with you. I think it will resonate with you. This is from Citi's Stuart Kaiser. He said this: "There is a tendency to read all moves in rates negatively. Higher rates mean growing inflation risk, while lower rates point to hard landing outcomes." Now, Jack, you've pointed it out yourself. Bad news was good news through much of the last decade or so, and now too much good news is bad news too. Can you make sense of that, Jack?
Of course. If we think back over the prior decade, bad news effectively kept the Fed sidelined and let us operate, particularly as equity investors, in an environment where the cost of capital is minimal, negative for so many companies. Now we get to a situation, thanks to the combination of COVID relief, the stimulus, the series of spending programs from fiscal authorities, plus a still accommodative monetary policy when you think about where real rates are, and you come back to the environment where inflation has been sticky, even if it's going in the right direction. The job market has continued to be really good news, and the consumer remains quite engaged, even if it's not necessarily as profitable as retailers would like. So I think the Fed remains reactive to the data rather than forward-looking, if you will, with respect to the data, and that leaves the equity market effectively getting whipped around by what happens at the long end of the yield curve.
Jackie, you're saying they're still too accommodative at the Federal Reserve. Are they not sufficiently restrictive?
I think that they are struggling to come up with just how restrictive they need to be. And this comes back to the age-old question, which monetary policy works with lags. And the question is, how much of a lag do we have to look at? When we think back to the big shock, economic surprises have been nicely positive over the past, call it 3 months, which tends to suggest that the overall investing environment or the overall investment community has been well calibrated with the outlook. Where we have seen surprises, it's been things particularly positive surprises have been labor and jobs, and that's probably the hardest data to come back to understand. And so I think that comes back to the Fed is acting with a lag in terms of looking at the data and not really effectively still be a little easier than they would like to be, all considered.
And because of that, another thing that hasn't broken in 2023 is just this correlation between stocks and bonds. Seema, last year, stocks and bonds fell together. This year, they've risen and fallen together. Again, this morning, you can see this playing out. Equity futures are higher, yields are lower on the session. Seema, we were told repeatedly by many people on this program, other shows too, on this network, that correlation was going to break down. Why isn't it breaking down?
I was one of those people. I still believe that diversification is going to be back in 2023. But as you said, it's not quite showing through yet. And the relationship where you have strengthening growth and yet still tightening Fed, I think is confusing things a little bit. Now, we do think that equities are going to find a tougher time as we get through 2023, and at the same time, bonds is going to be the place to hide out because typically as you get through to recession, you're going to have yields coming down. But I have to say, the first 2 months of the year have been very, very confusing. I think, as we've just heard, markets, we've all been whipped around pretty significantly. And it's important to take a slightly longer view because at the moment, following data by data, that's when you're going to get confused. You're going to take a slightly longer term view, take the fundamental perspective, and that's going to give you the way out through this.
Well, Seema, go back to the day before payrolls. Day before payrolls, equity market peaks on the S&P 500 up 9%, on the NASDAQ up 17%. The day before payrolls, everything was looking good. It was the day after the Federal Reserve. It looked like that disinflationary process was just starting. The chairman's words, not mine. Then the payrolls report drops, and the whole narrative switches, it changes. And Seema, I keep going back to this. Is there any reason to believe that the February data, the March data, repeats the resilience, the buoyancy of what we saw in January?
Well, I think we do, right? So it makes sense. Look, consumer spending is still very strong. Why is it very strong? It's being held up by savings and people dipping into credit card balances. The labour market, we know, is still very, very tight. And that's a continued kind of legacy from, I think, the stuff that we've experienced over the last 2 or 3 years. So that is strong. But you have to, again, look under the surface. None of that stuff can continue indefinitely. So we know that strong is strong right now, but there is weakness starting to build up under the surface. So when we look at this, we're saying, look, US economy very strong today. Unfortunately, that strength is almost going to be the undoing for the US because the Fed just has to keep hiking. That recession is going to come. Now, from our perspective, our forecast for US recession, we have moved it out. We originally had it at Q3. We're moving out to Q4. But we've also added another hike into our forecast for the Fed. So a peak of 5.5%. So unfortunately, it's a very confusing picture. But if you're looking towards the end of the year, the story is still the same. You've got interest rates at very, very restrictive territory, and you've got a US economy which is really starting to struggle because of the lag for monetary policy.
Mike Gapen of Bank of America publishing just seconds ago, building on some of this. The team writes over there, a big slowdown in consumer demand might be needed for inflation to return to 2%. This could require several more Fed hikes. Jack, when you think about how to invest around this scenario in the equity market, what's the best approach?
Well, I think that everything you and Seema were just talking about speaks to a Fed which continues to be data-led and late. So I think from the equity market's perspective, we began basically in January with a market that delivered a return consistent with, say, JP Morgan's long-term capital market assumptions. So we had a pretty good year in January. I think that highlights the fact that markets are going to shift their focus more towards quality rather than just chasing after what had worked in shorter periods of time. And I think but admittedly, to be really bullish on equities today, you have to have either one of two contradictory statements that you can hold together. One, either earnings massively positively surprised to the upside, seems inconsistent with the recession call that is, I think, still consensus, even if it keeps being pushed back. Or two, interest rates have to collapse, I think, from here, which seems unlikely absent a recession. So, when I put all that together, I still think equities are a better return on capital story on the intermediate to long term, given some of the embedded inflation pressures that still remain. But I do think you have to focus much more A, on quality, and B, on dividends. Get us some money, which borrows a bit from the excitement investors came into this year with fixed income being back. So show me the money effectively.
Where are you finding those dividend opportunities, Jack? Is it healthcare, energy still? Are they the two sectors for you?
Well, I think those are two places that offer us a unique combination of, in the case of healthcare, value. They offer us some longer term growth coming from demographics when we think about an aging population and some of the labor pressures from people opting out of working because of healthcare reasons. And they offer you income. When I look at energy, you wind up getting income. Maybe we can say the valuation story is a little less compelling in the energy sector. That's a bit more of a macro trade. So effectively, we kind of need China to continuing to return with reopening. But when I look at U.S. energy companies, they're letting their investors decide their reinvestment. I think that's really powerful from a long-term perspective. as they combine share buyback and dividends.
Equity futures right now on the S&P 500 up by 0.8%. We've got a bounce in the equity market this morning. Yields are a little bit lower by 3 basis points, 478. If you go back to the start of February, the closing high in the S&P 500 coinciding with the intraday low of the year on the US 2-year. The 2-year yield back then on February 2nd, 4.03%, and this morning was in and around 483. That's an 80 basis point move in a little under a month, a massive move. And Mike McKee, the conclusion appears to be this Fed, Mike, has more work to do.
Well, it appears that way, John. Now, what we're trading on in terms of the bond market right now is what happened a month ago in January, because February has been a month where we're getting surprising numbers that happened in January. So it'll be tomorrow when we start getting some up-to-date numbers. We did get durable goods today, better news than the headline. Headline pushed down by Boeing, but most of the products underneath that rose, including non-defense capital goods, ex-aircraft, which is what goes into GDP, up 0.8%. Shipments were up 1.1%. But this week, tomorrow, we get some consumer confidence numbers for February and the Chicago PMI. That kicks off a busy week, but not the week that everybody was waiting for, because we do get the ISM numbers. It'll give us some idea of manufacturing and services, but we do not get jobs this week. I had just gotten, when you were introducing me, an email from one of our clients who is watching, who wants to know why not. They do the jobs report, they release the jobs report the third Friday after the week that includes the 12th, which is the survey week. And because February is short, it pushes it to March 10th. We have gotten, in the latest month, though, a huge number of surprises. You saw that there, the City Surprise Index moving up very rapidly, and that's what's influenced all the bond buying. Now, take a look. Here's what we're going to be watching, and this is when it really gets interesting, is next week, even before jobs, we have Humphrey Hawkins, Jay Powell testifying before Congress. So that is going to be your market. You're probably... Well, I don't know. Do you think jobs, John, will be?
I think he probably wants to reschedule that for March 15th, to be honest with you.
I'm sure he would. CPI March 14th, and then the Fed meeting is March 22nd, and that'll be when we get the new SEP, the new dot plot, and we'll see if the Fed's view of what it needs to do matches what the market thinks.
Can I pick up on the question you were trying to ask me, because I think it is an important one? Yeah. What do you think is the most important one? Is it to see if payrolls confirm what we saw in January? Is it CPI again after PCE last week? What is it?
Well, I think the risk is that if we see the payrolls report ultra strong, it'll override maybe some of what Jay Powell says, because, as you noted, Powell has to speak before it comes out. But it'll be interesting to see if he ratifies in any way what the markets are thinking about what the Fed has to do, so people can set up for that March 22nd meeting, and then we'll see whether the CPI and jobs reports also underpin that.
Mike McKee, thank you, sir. A quiet week relative to what we're going to be expecting in the next couple of weeks. Looking for payrolls March 10th, then CPI a week or so after that. Seema, first to you, just how high is that bar to go away from 25 and return to 50s again at this Fed?
I think it's fairly high. I mean, realistically, looking at the data, I think they should be going at 50. I think they should have still gone at 50 even last month. But you know, they continue to get things wrong. That's unfortunate. We talk about markets being rocked around. Well, one of the reasons that they've been rocked around is because we're following the Fed, right? We're listening to the Fed. We heard Powell talk about the fact that financial conditions haven't tightened. And I think that really helped this narrative for the market that things are going to be okay. But as we know from last year, the Fed kept getting the inflation picture wrong. And for us, it's really important now to have a clear narrative. Now, I don't think the Fed is going to move from 25 to 50. I think they're going to go at 25, and they're going to go for a couple more 25s before they come to end.
A series of 25 basis point hikes is the call from Citi as well. They're looking for a peak rate of 525 to 550, at least, a minimum perhaps. They go on to say the bar to re-accelerate to 50 basis points is high, but it makes sense for markets to price some probability of larger hikes, and we've been doing just that. I want to get to one more research note. It's from Mislav Matejka at JP Morgan. He published earlier this morning. He said, we believe Q1 will mark the high point for the index levels this year, as the fundamental uplift does not come in Q2, Q3, post the relief in activity that is seen in Q1. This suggests that one should be turning more defensive as we move towards quarter end. Now, Seema, let's assume you agree with that based on what you've said so far. Could you tell me what you think defensive is in 2023 compared to what defensive used to be?
So defensive within equities is, I think, it's going to be the mid-cap space, and it's also moving away from the US. That is unusual because typically in any kind of economic downturn, you usually run for the US. This is the time to look international, Europe, emerging markets. The other part of this is if you can get out of equities, start looking at fixed income and alternatives, because that's where you're going to add a little bit of protection. It's not ideal, certainly, at this point in time. We can see there's a little bit further pain to come, but we do think that that's a safer place to be positioned than what you're going to get from equities.
Seema, we're going to talk about that theme in just a moment. We'll talk China. Seema Shah is going to stick with us. Jack Caffrey at JP Morgan. Hey, Jack, wonderful. As always, thank you, sir, for joining us. Your equity market up by 0.8%. I want to get you some movers. We can do that with Abby. Morning, Abby.
Good morning, John. And one reason that we do have futures sharply higher, the shares of Union Pacific absolutely soaring, heading to the best day since March of 2020. This, on, of course, on an upgrade from B of A to a buy with a new price target of $241, which is 10% better than the old one. On the news that they are looking for a new CEO, this following pressure from a hedge fund, Sorban Capital Partners. They're pushing for Jim Vania to replace Union Pacific's current CEO, Lance Fritz. Mr. Vania has experience posting improvement at Union P in the past. This, of course, as the COO. Again, investors liking this news, that stock absolutely flying. As for it being an M&A Monday, well, we do have some deal news. Oncology biotech Seagen absolutely soaring as well, up 13.4% in early stage talks with Pfizer for a takeout. They turned down a $40 billion deal last year with Merck, so analysts are very encouraged here, thinking that they could get a big premium. Range Resources, on the other hand, it is down sharply, down 8%. They are not a target for Pioneer Natural Resources, as had been rumored last week. And then finally, the biggest loser on laggard on the morning here in the pre-market, Tegna, this media marketer, well, the deal with Standard General may be dead on FCC opposition. That stock down more than 20%.
Abby, thank you. We'll pick up on a few of those stories around the opening bout. Going into the opening bout, 14 minutes away. Equity futures still higher. At the front end of the yield curve in the Treasury market, the 2-year was 4.85 a little bit earlier this morning. We've backed away from that. We're now down 2 basis points on the session to 4.79. Coming up, the White House delivering a warning to China.
Beijing will have to make its own decisions about how it proceeds, whether it provides military assistance. But if it goes down that road, it will come at real cost to China.
That conversation up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
When China talks rhetorically about the war in Ukraine, they tie themselves into knots because they know that going all in with Russia in this war in Ukraine would alienate a substantial number of countries that they are working hard to maintain good relations with. This war presents real complications for Beijing. And Beijing will have to make its own decisions about how it proceeds, whether it provides military assistance. But if it goes down that road, it will come at real cost to China.
The White House warning China against supporting Russia's war effort as China prepares for a state visit by a Russian ally. The country in the spotlight over the weekend as the Wall Street Journal reports that a lab leak was the most likely cause of the COVID-19 pandemic.
I can't confirm or deny. If we gain any further insider information, we will share it with Congress and we will share it with the American people.
On the latest down in Washington, AMH down in D.C. Morning, Anne-Marie.
Good morning, John. Some awkward diplomacy with China. On one hand, of course, you had Jake Sullivan out on the Sunday shows, the president's national security advisor, talking about and warning China that they are watching them on whether or not they will take this step potentially. Cross with the U.S. has really highlighted a red line in providing lethal aid to Moscow. The president said at the moment he doesn't think that's possible, but he said there would be consequences. Of course, the big question is what those consequences would be. And then we find out from this Wall Street Journal report that the Energy Department has changed their assessment about the origins of COVID-19, and they're saying this is coming from a lab. Now, what you heard Mr. Sullivan talk about is the fact that there is really no concise agreement amongst the entire intelligence community. But of course, this would make diplomatic arrangements with China even more complicated than they already are. And China already fighting back, saying that this is scientific and it should not be politicized. And right now they're blaming the United States for politicizing it.
MH on the latest. Anne-Marie, thank you down in Washington. Back with us for final thoughts. Seema Shah. Seema, I wanted to come to you on this. We talked about this over the last couple of months. China's gone from uninvestable in the last year to unavoidable and now somewhere in between. I want to understand from your perspective, do US-China relations and the tensions currently prevent you from taking direct exposure to the country?
It doesn't, but we do have a bit of caution here. So when we're looking at the China position, we're looking at it from about a 6-month perspective for a number of reasons. So one of them is certainly the geopolitical tensions, which do seem to be resurging, and we certainly expect that as China becomes a strong economic player again, then it's going to be in the interest for the US to try and push them back again. But the other part of this is that, when we look at the China reopening, there's a lot of investor sentiment exuberance. We certainly think that's going to carry China a little bit further. But we also have to start thinking about policymakers and what they're going to do with stimulus. So we're not entirely convinced that stimulus is going to be extremely strong, that could continue to carry China's growth very, very far. So this is a 6-month perspective from our side, and then we're going to revisit and see if it's something that we want to stick in or not.
Seema, how closely are Chinese equities and so-called China proxies correlating with US equities?
Well, actually, so that's a good question. So it is one of the things that we've been watching the correlations, and they have got a little bit closer in the last couple of weeks. But one of the things which I think makes sense is that as expectations for Fed tightening have gone up, and you've seen the further strengthening in the US dollar, a lot of the China proxies, of course, emerging markets are starting to struggle, which is what you would anticipate. Now, for this year, that is going to be an important narrative to watch. We have to see what happens with the US dollar. But either way, whatever we think about the Fed, if we believe that we're closer to the end of the tightening cycle than the beginning, then it should mean that we're near the ultimate peak for the US dollar, and then that should continue to help emerging markets and China proxies going forward. But, as is anything for this year, a lot of the economic variables need to be watched very, very closely.
I think for the year so far, the answer is ask me again in a month or a week or 24 hours, Seema, based on what we've seen. Seema, thank you. Seema Shah there on the latest. Equities right now on the S&P up 0.8%. Coming up the morning calls and later. Markets starting to price out the Goldilocks scenario. We'll get the latest with Sam Linton-Brown of BNP Paribas.
Big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg.
Minutes away from the opening bell, a lift here on the S&P by 0.9%, looking to recover on the Nasdaq by 1.1% on the Nasdaq futures going into the opening bell. Let's get you some morning calls. 3, here's one. Bernstein downgrading Williams to market perform, expecting lower gas prices given the warmer than anticipated winter weather. That stock's down 0.5. Next up, JP Morgan initiating coverage on Zillow with an overweight rating, forecasting a recovery in the real estate market. That stock's flying up 4% in the pre-market. And finally, Telsey Advisory downgrading Best Buy to market perform, seeing further downside given the challenging macro environment. That stock is down by 1% to 82.85. Coming up, BNP's Sam Linton-Brown was buying the beaten down European banks last summer, and they've been absolutely ripping ever since. That conversation still ahead.
We can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
24 seconds away from the opening bell this morning. Good morning to you. Equity futures elevated by 0.9% on the S&P 500. On the Nasdaq, positive 2 by 1.1%. Last week, worst week of the year on the S&P 500 for 2023, and a 3-week losing streak that we are going to see if we can snap. There's your opening bell. Switch at the board and get to the bond market. Yields were higher this morning and then lower by 3 basis points on a 10-year, 390. We had a little look again at 4%, couldn't make it. On a 2-year, came basically close to 485 and some, 478. We've backed away since then. We're down about 3 basis points on the session. In the FX market, the euro showing some strength after a week of weakness every single day last week. Monday, Tuesday, Wednesday, Thursday, Friday, euro weaker. Now 105.83, a bounce of about 1/3 of 1%. And crude, down 1/2 of 1% this morning, just short of 76 at 75.94 on WTI. About 30 seconds into this, equities advanced by 0.8 of 1% on the S&P. On the Nasdaq, up by a little more than 1 full percentage point. 2 stocks to watch at the open. One's Pfizer, the other Seagen. The Wall Street Journal reporting the 2 companies are in early stage talks for a potential acquisition. Analysts expecting a deal for Seagen could cost Pfizer more than $40 billion. Abby has more. Hey, Abby.
Hey, John. Well, we saw a similar story last year, only it was Merck, and it was a $40 billion price tag, but apparently Seagen turned it down. So analysts encourage that maybe something will happen here, but it is important to stress what you were talking about. This is Wall Street Journal reporting, and this is in early phase talks, if at all. And what is happening here, analysts saying that after basically a year of waiting for Pfizer to do something significant, they've done a lot of little bolt-on deals, that this potential acquisition shows that Pfizer's serious about growing their revenue beyond COVID. They're also saying that they appreciate the long duration IP and exclusivity around some of their antibody drug conjugates. And JP Morgan's very positive, Berenberg's positive, so it seems as though there is support for this. Now, relative to that revenue concentration, about more than 50% of their revenue in the fourth quarter had to do with COVID. So with COVID on the decline, hopefully they're really apparently looking to boost up the diversity of their revenue, and really particularly around oncology. As for Seagen's side, just a few shareholders here calling the shots. The Baker brothers have 25%, then Capital Group at nearly 14%, Vanguard, BlackRock, Wellington, Prime Cap. Again, last year, apparently with Merck, they were not interested in a $40 billion deal. That is the number that's being thrown around here. And again, if it's happening, early stage talks here, John.
Abby, thank you. Seagen up by a little more than 11%. Seconds ago, just some breaking news out of the UK. The UK and the EU reaching a deal to end the so-called Brexit dispute over Northern Ireland. There will be a news conference a little bit later, 3:30 UK time. So that's about an hour from now, between Rishi Sunak, the British Prime Minister, and the EU President, Ursula von der Leyen. Look out for that news conference a little bit later on this morning. Guy Johnson, Alex Steele will pick up that story in about 28 minutes' time. That headline dropped in just moments ago. The UK and the EU reaching a deal to end the Brexit dispute over Northern Ireland. More on that a little bit later. One stock to watch around the opening bell, Union Pacific. The company saying that it's looking for a new CEO following pressure from one of its largest shareholders, writing, quote, "The board is focusing the process on highly qualified candidates to identify a CEO capable of leading the company for a long-term tenure. The board expects to name a successor who will assume the position in 2023. Isabel Lee has more. Hey, Isabel.
Hi, John. That's exactly right. And if you ask Robin Capital Partners, a hedge fund, there's only one person for them, Jim Venna. Venna used to be the company's chief operating officer from 2019 to 2020, and he's known for his major cost-cutting measures and his efficiency style, which is why shares gained when he was the COO. And Sir Robin, who has a major stake in the firm, said, unlike typical shareholder engagements which come with major demands, it only has one ask, and that's to install new leadership. It even goes so far as to say that UNP's stock price will double in 2 years with Venna as the boss. It also said that no one is internally as qualified as him. And of course, Wall Street was quick to react. We have Bank of America Global Research welcoming the news. It upgraded the firm's stock to buy from neutral. It set a price target of $241. That's a roughly 24% increase from the close. JP Morgan also saying that the takeover will be a positive for the stock. It keeps its neutral rating. So Venna helped overall Union Pacific's operations a week ago, and you can see the margins fell after his exit. As background, Union Pacific has been the second weakest performing rail stock in 2022. Its shares fell around 20% in the past 12 months. This is why some investors are quite unhappy with his performance. So Union Pacific said it will name a successor this year, and we'll see how that plays out, John.
Some relief this morning. It's about, thanks for that. The stock is up by about 9%. If we closed here, one of the best days we've had for that name since 2020. From rails to retail, Telsey Advisory downgrading Best Buy ahead of Thursday's results. The analyst said this: we believe Best Buy's business is likely to experience a further decline related to the challenging macro trends weighing on discretionary consumer demand, given high inflation and rising interest rates, resulting in our lower 23 forecast for both sales and profits. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Best Buy shares are actually a little bit higher as trading officially kicks off. The stock had been lower pre-market. But in addition to the downgrade, you also have analyst Joseph Feldman. He cut fiscal year estimates for Best Buy, and it lands before Best Buy reports earnings on Thursday after what had been a pretty robust upswing. Shares had gained more than 30% between the end of November and early February. But as you can see from that chart, it's been in a bit of a downdraft the past few weeks. And it's not just Best Buy, John. You have other appliance sellers and consumer giants. They've also dropped over the past 2 weeks or so. And actually, in downgrading Best Buy, Telsey's Feldman cited disappointing outlooks from Home Depot, from Walmart, as signs basically that those difficult macro trends, they're going to continue to weigh on discretionary consumer demand. Now, longer term, Feldman does see Best Buy as one of retail's better operators, but the era of easy post-pandemic comps is over. You're looking at same-store sales there, and it's another double-digit drop that's expected. That would be the 5th straight quarter of declines. So stay tuned for Thursday's report.
Katie, thank you. As Katie pointed out about 6 minutes in, we were lower. We're now positive on that name. Best Buy up by about 1%. The broader market on the S&P 500 positive by 0.75%. The Nasdaq up a little more than 1 percentage point. Sam Linton-Brown of BNP Paribas keeping a close eye on this week's data, writing the following: the market has started to price out the Goldilocks divine disinflation scenarios, which were underpinning the everything rally, in favor of economic resilience but stickier inflation. Fundamentally, our view remains that activity data will eventually slow by more than the market is pricing in. Sam Linton-Brown, I'm pleased to say, joins us now. Sam, wonderful to catch up with you, sir, as always. You didn't really buy into the divine disinflation scenario. You're not buying into the resilience story either. Why not, Sam?
Good morning, John. Our view is that either growth needs to slow by more than the market's currently pricing in, or central banks will have work to do. So in January, the market was pricing in a scenario where inflation got to levels consistent with central banks' mandates, but without any material slowdown in growth and without policy having to get that restrictive or stay there for that long. We've had a bit of a repricing in the market in February, where there's more concern now that central banks will have more work to do if growth doesn't slow. We've priced central bank expectations higher, we've priced inflation expectations higher, and we've priced out the timing of rate cuts following when terminal rates will be reached. The view we have at BNP Paribas is that there's still some further room to run on that repricing. So either equities are at risk to come lower, or rates are at risk to still head higher.
If you had a bias right now, Sam, which one would it be?
I think in the near term, the bias is that both could actually play out on the basis that the market's in this process of pricing a more hawkish policy outlook for the Federal Reserve. The data we have this week is going to be important: consumer confidence, ISM manufacturing, ISM services, but more crucially will be the payrolls data that we get just beyond a couple of weeks from now. I think the key point here will be on earnings. The view we've got, sorry to cut you off there, John, is that you could have an upside surprise on earnings because average hourly earnings doesn't take into account compositional changes in the labor market. And what we've seen is that some of the higher wage cohort have been coming out of the labor market, while some of the lower paid workers have been coming in. And that trend might be due a bit of a reversal, which will push wages from payrolls higher in line with things like the employment cost index. That could trigger a further repricing in Fed expectations, which would challenge the risk backdrop.
Sam, based on your expectations, when you compare Europe to the United States right now, where do you think is closer to pricing in the terminal rate? At the ECB or the Fed?
I think in the US, in the near term, that's where there's a greater risk that the market needs to price tighter central bank policy. In Europe, we had a pretty significant repricing already as the market has priced out a recession on the basis of the energy crisis proving considerably less acute than had been expected. In the US, we're getting this ongoing surprise, however, where data simply is not slowing by as much as the market expected, either because policy lags are longer than people had anticipated or because central banks still have more work to do. That means we're in a scenario where there's really a lot of uncertainty for the market to be processing. And I think where the market's currently priced for the Fed is fairer than it was before, but from a risk-reward perspective, from a distribution of possible outcomes, we're probably nearer to where the market's likely to price the floor than where it's likely to price the ceiling. So we remain a bearish bias in the front end of the US curve. In Europe, it's a little bit more balanced. We'd be neutral on both the duration and the front end.
Where does that leave the bank's call then, Sam? And let's pick up on that. I remember the call from last year. It was last summer. I think it was around the middle of June. You said buy European banks, and I sat here just thinking, is this guy absolutely crazy? Is he nuts? A month later, the S&P, or rather the Euro Stoxx 50 Banks Index bottomed, and I think we're up something like 50%, 60% from that low. I think this year alone, year to date, we're up 20%. Sam, what did you see that ultimately materialized, and whether, I want to know, whether you're still long this sector?
Well, that's obviously a very generous characterization, but nonetheless one that's appreciated. Our view from here is that banks in Europe are still set to outperform. We think net interest margins have further scope to improve. In turn, the profit outlook is structurally better against still depressed valuations. So European banks are still a sector that we think will outperform. And more generally speaking, we think the European equity market is at less risk to sell off. Again, consistent with what we think the central bank might get priced to do from here than the US market. In the US, if we look at some of the more interest rate sensitive sectors, i.e. NASDAQ, trading at a 23 times, 1-year forward PE. For us, that looks too rich from a valuation backdrop, given the headwinds that will be felt from higher rates.
The enthusiasm you have for European banks, though, do you have the same enthusiasm for US banks? You talk more broadly about US equities and the NASDAQ there, but what about the banking sector stateside, Sam?
We'd be comparatively more cautious there compared to Europe. The valuation argument is less compelling than it is in Europe. I think as well as we talk about the relative equity call, that's going to tie in very closely with the relative currency call between the Eurozone and the US. Our view on euro dollar is that we're structurally bullish in the medium term. We talked about if the ECB have more work to do. I'd say almost independent of that, the key point in European fixed income is there didn't used to be any yield, now there is. From an equity standpoint, we know that Europe is an under-owned market. It's a market that's been beat up for many years. We think secularly that trend is in the process of reversing. And from a currency valuation point, it's still very cheap. So we think in the medium term, euro dollar is set to trend higher, even if we might be in this range-bound, choppy consolidation zone on the basis that Fed expectations might get repriced a little higher.
Sam, can I just put a number on it, if we can? I remember the day before payrolls, it was the day of the ECB. I think we saw 110.33 on euro dollar. We're back down to 105. What kind of levels are you thinking about?
I think we'll sustainably break 110 this year. Our target for the end of this year is finishing in the 110 to 115 range on the higher side. So we have a 114 number, and I think that's very much achievable. Interestingly, the repricing higher we've had in Fed expectations on the back of better US data, that's good for the dollar now. Higher rates are going to squeeze out what was a very strong consensus dollar short position, which had been built in the market very quickly, in our view too quickly, in 2023. But once that process has played out and US rates are somewhat more stable, the backdrop is one in which, relative to where we were 2 months ago, recession risks have diminished. And that type of backdrop, where growth expectations are revised up, is one which should be ultimately bad for the dollar, even if in the near term, while Fed expectations are just higher, it can squeeze out some dollar shorts.
Hey, Sam, this was great, and great call last year as well. Keep talking about it. Sam Linton-Brand there of BNP Paribas on its equity market and on that banks call from last year that's really materialised in a major way. You brought a market right now, 14 minutes into the session, positive by 0.8% on the S&P, on the NASDAQ, up a little more than 1 full percentage point. Coming up, more job cuts at Twitter.
There was a decent amount of overhiring across tech and in software and parts of semis. And we've seen those companies get out ahead of the market in terms of announcing layoffs. So that's been really productive.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
News breaks. No one covers the world like Bloomberg.
6 people have died from these latest quakes, adding to the 41,000 plus people who've died in those major quakes 2 weeks ago.
A top Sam Bankman-Fried associate said to be nearing a plea deal.
How does that help build the case for the prosecutors against Sam Bankman-Fried?
Biden is here to say we will stay with Ukraine until the very end, and that's really a show of support as well for the allies.
Bloomberg, your global business authority.
Decent amount of overhiring across tech and in software and parts of semis. And we've seen those companies get out ahead of the market in terms of announcing layoffs. So that's been really productive. And so I expect these companies are going to weather this economic and policy storm pretty well.
A fresh wave of cuts over at Twitter, the layoffs hitting employees across the company, including engineering and product teams. Sources telling Bloomberg some employees learned the news via an email, others finding out when they couldn't log into the internal system. Kaylee Lyons joins us with more. Hey, Kaylee.
Hey, John, it's not exactly clear how many employees were laid off in this round of cuts from the company. Sources told Bloomberg that they believe it was in the dozens. The information reported it was about 50 people. And while that may seem like a relatively small number, remember, this follows 3,700 job cuts back in November. Excuse the number there on that full screen. Remember, Elon Musk took over this company after overpaying $44 billion for it, immediately cut about half of the workforce closely after closing that deal because he needed to cut costs. And once again, we are seeing that happening over the last several days, including including even in the higher ranks of those left at the company. Platformers saying among those cut this weekend was Esther Crawford, who was one of the executives who had been in charge of the subscription service Twitter Blue. Now, obviously, a lot of this is Twitter specific, but John, this is part of a broader trend that we are seeing in technology. Companies having to right-size their businesses, reduce their workforce now that they aren't growing like they were in the pandemic when they hired so many people, which is why we have seen over 100,000 layoffs in the tech sector over the last several months. And it's showing up in the economic data as well. You're seeing in the information technology sector jobs going down in both the last reports, December and January, even as overall employment picked up. We'll have to wait and see what the latest data tells us come next jobs day, next Friday, John. But obviously, there is a lot of pain being felt in the tech sector right now, and especially for their employee forces.
March 10th, the next stop, 2 Fridays away. Kelly, thank you for the latest. As always, Kelly Lyons there on Twitter. An eventful weekend for Elon Musk, a busy week coming up for him as well with a different company. Tesla's annual Investor Day coming up on Wednesday. The EV maker presenting a third version of Elon Musk's master plan. Musk writing in a tweet, the plan includes, quote, the path to a fully sustainable energy future for Earth. David Welch has more. David, walk me through what's on the agenda this week at this Investor Day.
Yeah, they haven't said much, but I think one of the big items has to be the whole supply chain of batteries. Everyone's racing right now to secure contracts to get lithium, to get cobalt, nickel, everything you're going to need. Tesla has talked about lithium iron phosphate batteries too, but they're also apparently in the mix to take a stake in Sigma Lithium. So like General Motors has taken stakes in some of the mining companies and mining projects that they need to make all of these electric vehicles over the next decade, I think Elon will talk about how they're going to secure all of the different minerals and metals that Tesla is going to need to hit the huge volume targets that he has going forward. I think another thing will be, does the Model 2, the small, cheap Tesla, is there anything real there? He wanted to do this years ago. Last year he said that they had sort of shelved it, but there's a lot of expectation that maybe he'll talk about that, bring it back to life. They need a cheaper electric vehicle to reach the masses and to hit some of the long-term volume targets that Tesla has. And then also maybe we'll get some more specifics on production timelines for the Cybertruck that we're supposed to see at the end of this year, but there's, this is Tesla. They like to miss, or I don't think they like to miss their production targets, but they often do. So we'll see if the Cybertruck's going to come out on time and maybe get some real production numbers on that as well.
In the past, it just didn't matter if they missed things because, David, the stock performed so well. If you talked to me about this 2 months ago, people would have said the CEO's under pressure. People are asking whether he's distracted. The stock's on its knees. Since then, year to date, up 66%. Is the CEO no longer under pressure and distracted?
Look, the stock is still way below where it was last November. So the company has really, it's come back in recent months, but it's not where investors want the price to be. I don't think Elon's under pressure necessarily, but I still think he's being closely watched. The company is being closely watched. A lot of issues here fundamentally that Tesla has to deal with. They have a lot more competition now. The conventional, or what they call legacy automakers, Hyundai, Kia, General Motors, BMW, Mercedes, are all coming out with a bunch of electric vehicles right at the time when Tesla has a lot of capacity coming online. Tesla's models have all been on the market anywhere from 3 or 4 years to 12 years for the Model S. Some of those are a little stale. They need some new product. They're not hitting their growth targets. So I think they're being closely watched. I don't think there's necessarily an argument that Elon ought to be removed, but investors are going to want to see something that says they're going to regain momentum at this company.
Stock's up right now by 4%, 22 minutes in. David, wonderful as always. David Welch there on the latest, looking ahead to Tesla's Investor Day. Got a bit of time for a sector price check. Let's get some price action at the sector level with Abby. Hey, Abby.
Hey, John. Well, we are looking at the S&P 500 gaining by about 0.8% right now on anemic volume, 22% below the recent average, but holding that 200-day moving average, and it is on strength from a variety of sectors. We have discretionary industrials, real estate, and tech all up more than 1%. The one lagging sector is energy, down about 0.3%. And over the weekend, of course, Warren Buffett released his annual shareholder letter. In terms of the sectors that represent his biggest holding, we have tech and financials up this year, but energy and consumer staples, not so much.
Abby, thank you. Your trading diary up next.
did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Trying to snap a three-week losing streak on the S&P 500, attempting to bounce back from the worst week of losses of the year so far in 2023. Equities up by 8 or 0.9% on the S&P 500. On the Nasdaq, up a little more than 1 full percentage point. That's the price action. Let's get you the trading diary. The events you need to be looking for over the next couple of days into the weekend. We'll get pending home sales at the top of the hour. A host of Fed speak. Jefferson, Goolsby, Kashkari, Waller, Logan, Bostic, Bauman, all on the agenda this week. Goldman and Chevron holding their annual investor days on Tuesday, plus earnings coming from Target. ISM Manufacturing, a number of European PMIs as well through the week, with Tesla too. Another round of claims coming up on Thursday with Macy's and Nordstrom reporting as well. From New York, that does it for me. This is Bloomberg.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you've got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Benegold as an opportunity to leave that troubled home. Benegold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Benegold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interests of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. I think education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor. Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation, a language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings. As described about. Hey, Ruchita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW, and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or a musician in this world. So these are the positive images that are associated with identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus, and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities, and most of them got institutionalized now. So, for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
They're stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university, and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand, and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the Garden City feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore, if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over.
Connection lost.
Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage, and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
You need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year, because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the, like, profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Thea and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice: nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology, and live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高，但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers.
The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king will be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce. And he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的